The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances.
It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, facing an ultimatum. The U.S. threatening to strike power plants unless Iran reopens the Strait of Hormuz, keeping oil at multi-year highs and gas elevated as the war enters week 4. The energy shock morphing into a bond market rupture, sending yields even higher. We begin this hour with the president's ultimatum, posting Saturday evening. President Trump writing, if Iran doesn't fully reopen without threat the Strait of Hormuz within 48 hours, the U.S. will hit and obliterate their various power plants. That deadline just hours away.
13 hours, 44 minutes, according to the president, when potentially we have this deadline, according to him, that there will be a serious escalation if the Strait of Hormuz is not opened. What is so interesting is it came over the same course of the weekend when Friday evening after 5 p.m., the president actually said they were looking at winding down, which is why you have Tehran, Gulf countries, and financial markets, Jonathan, on edge.
In this market right now, in crude, we're pricing higher for longer. This is a change. Let's check it out. Check out the front month of the futures curve and compare it to where December is trading right now. And you'll see the bigger move is taking place at the longer end of the curve. The December contract coming into this war, trading in the 60s. It's now trading close to 90 so far this morning. And the larger move at the very back end of the curve, which tells you at the moment, for this year at least, we're pricing higher for longer.
Yep, higher for longer when it comes to energy prices. That potentially means higher for longer when you look at the gasoline pump. I checked AAA this morning. We are just a hair, a smidge away from $4 a gallon across the national average. And all of this, Jonathan, is for the fact that people are starting to wake up and realize even if the Strait of Hormuz does become open, the damage is done. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. It is going to take months to get them back to operation.
We've been tracking this as follows with the following framework. Take the energy shock, push it through the bond market. Energy shock, bond market rupture. Check it out, 2s, 10s and 30s. Yields at the front end of the curve rising for 5 consecutive days. In 16 trading days, we've had a 60 basis point move and we're just short of 4% on 2s this morning. Higher for longer in the energy market, higher for longer in the bond market.
You have to think, is this where potentially the president starts to wake up and feel yippee? Remember, it was Liberation Day. It was around these levels when he started to get concerned about his policy. He didn't like this idea of the question of the Trump put, would you reverse policy? The problem he has now is he is only one party to this conflict. And if he wanted to reverse it, he is going to need the Gulf Arab countries to get on board, the Israelis, and of course, another party, and that's the Iranian regime.
We've got a lot to work through this morning. We're kicking off Monday morning with futures, negative 0.75% on the S&P. Coming up this hour, Jeff Yu of BNY with stocks under pressure. Norman Roule of CSIS as President Trump gives Iran an ultimatum. And Michael Haigh of SocGen on how crude could hit 150. We begin this hour with our top story. President Trump threatening Iran with an ultimatum to reopen the Strait of Hormuz by later this evening. Bloomberg's Jemana Basechi joins us now for more from Dubai. Jemana, that deadline just around the corner.
Yep, and the entire region is on edge. I will say it was interesting that we heard from the U.S. Treasury Secretary Scott Bessent over the weekend, and he said sometimes it's necessary to escalate in order to de-escalate. But what we're seeing right now is who has escalation dominance. So essentially what we know is President Trump put up that Truth Social post on Saturday evening, 7:45 p.m. Eastern Time, threatening Iran to reopen the strait with no threats. And if they did not follow through on that, then the U.S. would not hold back at striking Iranian plants. Now, Iran was quick to respond the next day, and they said in turn that if the U.S. followed through on that threat, they would then strike back once again at key energy infrastructure in the region, alongside information technology and desalination infrastructure as well. And let me just spend a moment on that, because to what Annmarie was saying, if you look back, and the war has been going on for 24 days now, the IEA are saying there are 40 sites, 40 energy sites in the region up until now that have been damaged or severely damaged by the Iranian attacks. They're also saying that desalination plants could be a target here. That would be a game changer for the region, because depending on which country that you're looking at, about 70 to 90% of the water is derived from these desalination plants. So there is a lot of nervousness about whether President Trump is actually going to follow through on that ultimatum. It translates to around middle of the night over here in the region. So we'll see what happens over the next 24 hours. But irrespective of that, I think what's become clear from all of this is Iran have realized the leverage that they have over the strait. And it is not what they say shut, it's effectively under their control. President Trump is trying to reduce the chokehold that they have over it, but with limited appetite from allies to get involved. You know, we've heard from the NATO Secretary General over the weekend, Marc, they said that they're working on a plan to help assist the U.S. with the maritime mission. But ultimately, the situation we're in now is it is still effectively shut. And as long as it's shut, you're going to continue to see this upward push on global energy markets. Plus, you have to factor in the ongoing damage that is being sustained at many of these energy sites. And even just this morning, ADNOC, which is the main energy operator here in the UAE, they too are saying that they're going to have to start limiting LNG production. So the knock-on effects are continuing. As we head into another key ultimatum, the next 24 hours will be crucial once again.
The pressure is building. Jemana, stay safe. It's going to catch up as always. Bloomberg's Jemana Basechi there, leading our coverage out of the region as this war enters week 4. She mentioned the IEA. Fanny B-roll in the FT over the weekend. Check out this out. Volume of gas cut off is double what Europe lost from Russia in 2022. More oil lost now than the twin shocks of the 1970s. Fanny B-roll calling this, quote, the greatest global energy security threat in history.
It's basically this two-pronged approach what we have right now in terms of LNG being taken offline as well as actual crude barrels, which is why he's saying it's these two massive energy shocks of the past, 1970s most recently, 2022, confounded in one crisis right now.
Here's the view on Wall Street so far this morning. Jeff Yu of BNY writing investors are increasingly fatigued by the lack of resolution. The risk of further market adjustments is rising, not fading. Jeff is welcome for more. Jeff, welcome to the programme. We've seen a major adjustment in energy. We've seen a major adjustment now in the bond market. How far along are we in the adjustment process for equities?
I think no one really knows at this point, and we're looking at EM this morning pretty much given up all its gains for the year. I think the first phase is pretty much done, and what I mean by that is the overheld positions, the high-performing positions, your careers of this world, they have basically given up this year's gains. But that's the first phase. The next phase is now we look at the impact on balance of payments, the impact on margins. Do we move into an outright correction mode where you've not only given up your gains for the year, but you move into an outright loss and a severe loss? I think that's the next phase where markets are looking at. And we just don't know what resolution even looks like at this point. And I think that's where the focus needs to be.
Jeff, many are shaken by memories of 2022. Stocks down, bonds down. What are the risks of a repeat of 22 for the year ahead?
So here's where I'm pushing back against market pricing right now. I look at this morning, 4 hikes from the Bank of England this year. Seriously? Right. So I'll just give you one figure here. The UK savings rate right now is approaching 10%. In 2022, it was barely 2.5%, 3%. So households have been retrenching for several quarters now, not just in the UK, but in Europe. The place in the cycle for Europe is very different compared to 2022, where we still had this post-COVID demand expansion. So that's where I think markets are really pushing the envelope a bit in terms of what they think central banks can do. They've learnt their lessons from 2022. They're saying the right thing. So I think central banks are going to be as hawkish as possible without hiking. That, at least, is the impression I got from last week. So I think that's where some correction is needed as well. It's not all doom and gloom, same as 2022.
Yeah, Jeff, I'm with you, because 22 was a shock for the market, not a shock for GDP. This feels different coming into 2026. This could be a real growth shock. At some point, the outlook gets so bad it's bullish for bonds. Are we close to that point?
I don't think we're there yet because, as you said at the top of the programme, they're looking for resolution, but also, what does resolution look like and what does the supply chain look like up ahead? I'm actually, in terms of prices, I'm looking at food prices right now, less so perhaps in developed markets, but in emerging markets. Again, what has been a high-performing element. Australia's announced that so one of the ammonia plants, which is key for fertiliser, supplies 5% of the world's fertiliser. That's going to shut down for about about 2 months. That's going to have a knock-on impact. India, Bangladesh, these countries, large fertilizer producers, they need it as well. India's asking for fertilizer from China. So this is where I think the knock-on effects could drive inflation higher, not just in EM, but globally, and that will feed through down the supply chain into CPI as well, something we need to keep an eye on. So does that actually introduce capacity to cuts rather than not hiking is something that will be uncertain as well.
Jeff, I'm glad you brought that up because it's not just LNG and it's not just crude oil, it's helium, it's fertilizers, and you're looking at the immediate inflationary shock of that. But long term, isn't that also a growth shock?
It absolutely is a growth shock. And as you stated, helium, that's crucial. Japan, I think, announced last week they had about, 2 to 3 months worth of helium supplies left. I think markets want to look at how much helium is in South Korea, in Taiwan. Why? Because crucial to manufacturing chips. And if we think about the AI theme, that's really been driving US growth, global tech-based growth. If that starts to constrain this theme, which until now has been like one of the positives for the global economy, if that starts to unwind, then the growth shock, could be larger than expected as well. So again, right now, we're in the phase of understanding, what the secondary, tertiary implications are from all of this.
Makes it really difficult to understand the risk-reward in equities right now, Jeff. So let's talk about the price of the story. 5%, 6% away from all-time highs. Is that attractive yet to you?
So again, we don't know, where this and how this ends, and we have to define that. So if it's going to be, so put it this way, in terms of scenarios, starting to look attractive, absolutely yes. But if the knock-on supply effects drives up costs over, let's say, a sustained 12 to 18-month period, let's leave the demand side from the household out of the equation for a second. That will impact margins, right? If helium's going to be more costly, if other input prices are going to be more costly, then we have to factor in that discount into equity markets as well. If it's going to be short-term production issues, 2 to 3 months, as has been stated, then I think it's manageable. Anything more prolonged, if we're talking 6 to 12 months, then a discount is needed.
Hey, Jeff, it's got to catch up. As always, Jeff Yu there of BNY out of London this morning. We've had the energy shock, the bond market rupture in play, and now we're trying to calculate the growth scare. That's where the market kind of is coming into this week.
And when it comes to the growth scare, you need to think of crude oil and how long potentially these high inflated prices will last. And then at some point, does that trickle down to other parts of the economy, to goods and services? You look where diesel is, it is very elevated right now. And that is going to have an effect on a number of issues. And then you take into account helium for semiconductors and fertilizer for plants. This is why this is going to be incredibly difficult for politicians as well as for policymakers.
Speaking of politicians, gasoline basically at $4 a gallon now on average in this country. That's a big change in the last 3 weeks or so. Equity futures on the S&P negative here by 0.7% on the S&P 500. With an update on news worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Iran is carrying out a fresh wave of attacks across the Persian Gulf ahead of President Donald Trump's deadline to reopen the Straits of Hormuz. Trump delivering an ultimatum to fully reopen by 7:44 p.m. Eastern tonight, after which he's threatened strikes on Iran's power plants. Iran is threatening to mine the entire Persian Gulf, not just the Straits, if the U.S. or Israel attacks its islands or coastline. Here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 13 people were hospitalized with injuries. And the U.S. is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial government shutdown, leading to lengthy delays at U.S. airports. That's your Bloomberg brief. John.
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the program, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
A conversation up next with Norman Roule of CSIS, live from New York City this morning. Good morning. Three-day slide on the S&P becomes day 4. Equity futures negative by 0.8% following a 4th consecutive weekly loss on the S&P 500, the longest in more than 12 months. The epicenter for the pain, you know it well, crude, WTI and Brent. WTI overnight trading in triple digits, 99 so far this morning, up by 0.9%, up on the month by 40 to 50%. And this stock down on the month by something like 15. United Airlines, the corporate reality check going into the weekend. United put out a statement. Got lots of cash compared to COVID. Balance sheet's good, demand is tremendous. But take a listen to this from them. Jet fuel prices have more than doubled in the last 3 weeks. If prices stayed at this level, it would mean an extra $11 billion in annual expense just for jet fuel. For perspective, in United's best year ever, we made less than $5 billion. The warning from the airlines.
It's getting very expensive, and this is a warning from United Airlines here in the United States of America. These warnings already came almost immediately in Asia from some of their airlines because they feel the energy shock first. They are front lines of energy shock. And now for the airlines, it has gone global in terms of how much more expensive they realize the jet fuel is going to be. You know what that means, Jonathan? Higher ticket prices.
They're planning for the worst and hoping for the best. Bramo will have more on United Airlines when she's back with us tomorrow morning. Look out for that. Under surveillance so far this morning, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. And now General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Sometimes you have to escalate to de-escalate.
So here's the latest this morning. President Donald Trump giving Iran an ultimatum to reopen the Strait of Hormuz or have its power plants bombed. Annmarie, Iran launching fresh attacks across the Persian Gulf just hours ahead of that deadline later this evening.
So they're launching French attacks, and they're remaining very defiant in terms of some of the rhetoric we are hearing out of the country. So they are saying that all energy, information technology, and desalination infrastructure belonging to the U.S. and Israel are targets. They are saying that also they will completely continue to close the strait if this continues. And then this one, Jonathan, caught my attention. The head of Iran's parliament says that any U.S.-linked financial institution holding American government bonds, U.S. treasuries, would be targets alongside military bases. So potentially what they are saying is that if this were to come to fruition, they would start attacking banks in the Middle East and to American partners and Arab partners and Israel if the president comes through with this ultimatum he has.
This has been a feature of the past 3 weeks and change. When we say Iran, who are we talking about? Who actually has a voice? Who is leading this effort right now, this response to retaliation we see across the Gulf? That one person? Someone else? When we say Iran, who are we talking about?
That's a great question, because when the president is asked about this, he says he doesn't even know who is running the country. Obviously, we have the new supreme leader. He is injured, according to reports, and we have not seen him, even though we have had Persian New Year. Normally, traditionally, you would have this video statement or speech from the supreme leader. We only got a written statement. So that is very curious. But when you look at when it comes to the regime, head of parliament, the foreign minister, the president, all of them are out front.
Here's the take from Norman Roule, the former senior U.S. intelligence official and senior advisor at CSIS. He writes the following. If the U.S. executive executes strikes on Iranian power plants, civilian infrastructure would become a primary battlefield and oil would reprice sharply for an extended disruption scenario. Norm joins us now for more. Norm, welcome to the programme. Can you help set the stage? What are we set up for later this evening?
Good morning. So 3 weeks into the conflict, a new battle space dynamic has been created. Despite the extraordinary campaign results of the United States and Israel, the Iranian government has survived. So the war has evolved from a Gulf shipping and gas infrastructure crisis into a deadline-driven strategic depth and civilian critical infrastructure contest that openly involves control of the Strait of Hormuz with all energy systems, regional power infrastructure, desalination systems within a potential escalation envelope. Once these systems become explicit targets or even threat objects, you in essence have a situation where the market will now need to price in not only the crude and liquefied threat to natural gas, but also the reliability of electrical systems, water security, repair times, and the higher probability of allied burden sharing of all of the Gulf Cooperation Council partners.
Norm, when the president puts out a statement and has this ultimatum about opening up the Strait of Hormuz, or he's going to go after power plants. Do you think that statement would come from the President of the United States if he was unwilling to do so?
No, I believe the President of the United States has a serious intent of taking a greater action against Iran. I also believe that U.S. Forces in the region are more than capable of executing the President's wishes, but they would prefer to undertake these actions when the conditions are most appropriate. Now, they can do whatever the President requires. Fully opening the strait would require a reduction of Iran's UAVs, its drone threats, and probably undertaking more action against the Strait of Hormuz's Iranian infrastructure, and waiting until we have the full contingent of additional Marines and perhaps some additional air assets.
Norm, you've been in the room. The president will have a number of options in front of him. There's reporting over the weekend that he mulls Karg Island, a takeover of that island that's just some miles off the Iranian coast. Can you go through all the options right now you think are being presented to the president?
Well, I'd prefer to avoid all of the options, in that perhaps the Iranians are watching, and giving them a school answer may not be the best of ideas. But it's likely that the president's overall approach is to convey to the Iranian government that they're about to lose control and the revenue from their most strategic asset, and that idea is going to ripple through the strategic leadership of Iran's government and compel them to push for negotiations and to make concessions on several points, which is in essence to give up the idea of nuclear weaponization, the enhancement of their ballistic missile program, the Quds Force activities within the region, and to return the Strait of Hormuz to international control, vice their control.
There is some speculation that a ground operation could be imminent. Can we go into the realm of speculation together and talk about the geography, a geography that you know well? How difficult would a ground operation be in a place like Iran?
Well, I'm not sure the issue is of difficulty. U.S. forces are extremely capable. All ground operations have a lethal component, and no one should diminish the threat to U.S. forces. I think you want to ask instead what the ultimate goal might be. What is the purpose? Are we trying to retain territory? Are we trying to send a message to Iran that we can take territory? Are we trying to destroy key facilities? The question is, what message are you trying to send to the Iranian leadership? We've already sent the message that we can destroy anything in Iran. We can control any physical space in Iran. We control the skies, which means we control the ground.
Norman Roule with CSIS. Norm, thank you, sir. Appreciate it. Of course, the objective at the moment of the conversation, taking Karg Island.
Absolutely. That was the reporting over the weekend, that this is what the president is weighing, potentially going after Karg Island. We've already hit, the U.S. military has already hit military installations on Karg Island. Potentially what would be next was taking control of it and then having complete control of the Iranian economy lifeblood. 90% of their crude gets processed on that island.
We often have this conversation. The president backs out when things get tough. Backs away, changes course. Saw it last year. According to so many people in this market, gasoline prices getting closer to $4. No sign of him backing down. Massive moves in rates over the past week. No sign of him backing down. Conflicting statements, yes. A conflicting statement going into the weekend on Friday after the closing bout. Then he said something else on Saturday evening. But ultimately, no real sign that the U.S. military is backing down and backing out.
So Friday after 5 p.m., when I saw the markets closed, and then I also, of course, saw the president's truth, I thought maybe this was the moment he wanted to back down. And then that was completely reversed with his next statement saying that there was going to be this ultimatum to the regime. You need to open up the Strait of Hormuz, relax your control. You know, you have to let every vessel in, not just the ones that you deem friendly, or there is going to be serious consequences. So right now, that is why everyone is on edge.
Right now, futures negative by 0.9% on the S&P 500. Up next, Michael Haigh of SocGen on why time is working against oil markets. Plus, Yohara has your morning movers. Mining stocks sinking as the war in Iran weighs on metals. For the last 3 weeks, every Monday has started Sunday evening, and it started with this. What's the price of crude? This is the price of crude. WTI and Brent. WTI briefly, triple digits, 99 this morning. Brent crude, let's call it 114, a 50% move in 16 trading days through the month of March. Amazing. That's the energy shock. Here's the bond market rupture. Huge moves at the front end of the curve as we price out easing and begin to price in hikes in certain countries. Stateside, just short of 4% on a 2-year yield, up by 60 basis points in just a few short weeks. And in the UK, up more than 100. That's a major, major bond market move. That's the bond market rupture. Now let's talk about the potential growth scare. On the S&P 500, down every single week so far this month. We're down 5% from all-time highs. Within the S&P 500, refiners up by 17%. Consumer discretionary down by 7%. To what extent have we repriced growth sufficiently for the shock in energy and the shock in bonds?
And you know what, Jonathan? It's not just the shock in energy. It's not just potentially that gasoline prices are going up. We are just there when it comes to $4 a gallon of gasoline, just a hair away, and I imagine it's going to hit that tomorrow. What happens when all this starts to creep through the supply chains? Your food costs, other goods, potentially even services becoming more expensive. And you have to think, central bankers around the world remember just what happened in 2022 when they said this inflation was transitory. Is it, or is this going to be more engrossed in the supply chain? Big question for Governor Miran of the Federal Reserve later on this morning. The biggest dove on the committee is going to join this programme at about 8:45 Eastern Time. His first conversation following that dissent, that push for a 25 basis point interest rate reduction at the Fed's last meeting. What's the argument now for lower interest rates with the market pricing in higher rates? I imagine the argument he will make is actually that this is, and it's not a good one. No one wants to hear that this maybe potentially in the short term is inflationary, but you are that concerned that it is going to be an economic shock to the supply chains, and it's going to be lower growth and maybe at some point for some of these companies, layoffs. Governor Miran, 8:45 Eastern Time. Don't miss that conversation as we count you down to the opening, about 3 hours away. With your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing mining stocks under pressure this morning as they track gold's decline, down for a 9th straight session and coming off of its biggest weekly drop since 1983. And in silver, we are seeing an even sharper move as you're seeing how rising yields are pulling money out of the precious metals trade. And no surprise, as you gave that market check on oil, that we are seeing oil stocks surging this morning as we continue to see oil push higher. Brent up for a 5th straight session with no de-escalation in sight when it comes to this war. As we've been talking about all morning, Iran striking sites across the Persian Gulf, even as it faces that ultimatum by President Trump to reopen the strait by tonight. And I will say Cheniere Energy is benefiting from an upgrade by analysts at Morgan Stanley, so that stock outperforming up 4.3%. And another bright spot in this market is Synopsys. Shares are up 1.6%. On a reporting that activist investor Elliott Management has built a multi-billion-dollar stake and is now pushing the company to better monetize its chip-making software, because this is a business that is at the center of the AI build-out, yet has not kept pace with some of the broader chip names. John?
Yahira with the latest. Yahira, thank you. More from Yahira later this hour. On our radar this morning, Iran threatening to lay mines across all routes if the Persian Gulf is attacked by the US or Israel. Iranian officials saying, quote, the entire Persian Gulf will be practically blocked. Elsewhere, Iran carrying out fresh strikes across the Middle East in the hours ahead of President Trump's ultimatum to fully reopen the Strait of Hormuz. The UAE reporting new drone and missile attacks overnight. And finally, US allied countries pledging to lead a multinational effort to help secure the Strait of Hormuz.
22 countries, most of them NATO, but also Japan, Korea, Australia, New Zealand, Bahrain, the UAE have come together to answer the president's call to make sure that we secure the free sailing through the Strait of Hormuz.
President Trump previously blasting NATO allies for failing to act, with Rutte saying it's only logical European countries need a few weeks to come together.
So right now they're talking, and he talked about how he is in constant conversation as well with the president. But to that last point you made, Jonathan, this comes after the president blasted NATO allies and saying that NATO is nothing but a paper tiger without the U.S. involvement. Now you see the European allies and some other Asian allies talking about it because they might not have a choice. If energy prices continue to go higher, they might need to do something in terms of this coalition to try to reopen the strait.
It really hasn't been a great start to the relationship between NATO and the US. And I would be more specific, I would say European partners and the United States. Going after Greenland the way the US did at the start of the year, I think upset a lot of people. The comments on the way out of the World Economic Forum questioning how committed their allies were 25 years ago in the war in Iraq and in Afghanistan, and the amount of tours that individuals did, NATO allies, that fought on the front line, shoulder to shoulder, with US military officials, and yet the president questioned whether they were on the front lines at all. And here we are. We don't need NATO, we need NATO, we don't need NATO, we need NATO.
It's a little bit confusing. And to that point, this just might be too much for European allies, especially British troops, which did a tremendous amount of work in fighting alongside American troops in Iraq and Afghanistan. You also have to remember, I believe it was the Vice President, J.D. Vance, who told European allies, this is an individual who obviously has been very critical of the Iraq war under Bush, has said maybe it was the European allies should have had more of a stronger backbone and stepped up to the United States. Well, I think some capitals in Europe are actually saying, we have our backbone, we don't agree with this Iran war, and maybe that is why we're not going to send this coalition.
Let's stay on the energy story. Crude hovering around multi-year highs. Michael Haigh of SocGen writing, with each passing day, the market grows more strained. With no resolution in sight, prices could climb towards $150 a barrel in April. Michael joins us now for more. Michael, welcome to the programme. Your note was one of the first notes I read to start the week. Scenario B. We're very close to what you call Scenario B. What was Scenario A, and what does Scenario B look like?
Scenario A, first of all, good morning. Thanks for having me. Scenario A was our base case scenario at the start of March. The market was pricing in a very quick resolution to this conflict. So our Scenario A was that we see the Straits opening up by the end of March, but prices getting up to $125 a barrel. Looks like we're going to have to adjust that, move to Scenario B, where we have this conflict continuing through April, and that brings oil solidly up to $150 a barrel.
Michael, are you now pricing higher for longer? That's not just a short-term story, that's a long-term problem?
Yeah, unfortunately, that seems to be the case, because every day that goes by, oil taken off the production makes it harder to come back. Obviously, infrastructure gets more and more damaged. So, yes, higher for longer, I'm afraid.
Michael, this was an issue for the equity market, the issue. I think the source of comfort was we had extreme backwardation in the futures curve. Yeah. And for people who aren't in your world, that just meant the front month of the futures curve was really elevated, but the market was pricing a short-term problem, and we had this steep drop-off through the rest of the year. You see this playing out this morning, the opposite. We're starting to lift the back end of the curve, starting to price in the higher for longer scenario. Michael, this raises the question of demand destruction, so-called demand elasticity. What are the realities for the energy market? When does that destruction creep in?
So, well, there's one thing to not being able to afford oil because the price is too high, and the other thing is not being able to get the oil, and that's the bigger concern. So, generally speaking, from a price perspective, and when we talk about demand elasticities, the oil market is fairly inelastic. That means that when prices go up, people really can't change their behavior that much. So, given the fact we've had about a 50% increase in oil prices since the end of February, that would ordinarily mean, from a price perspective, you would lose about 1.2 million barrels a day of oil demand as people can't afford it. If we go to the $150 scenario, then we'd be talking over 3 million barrels a day of oil demand destruction because of the price effect. But as I mentioned, it's not really just about the price. It's about that some countries can't get the oil. So you're already seeing airlines put on surcharges, cutting flights. You see refineries in China cutting their runs. You see ethanol crackers cutting their output because they can't get the feedstock. So there are some countries in Southeast Asia that maybe have 15, 20 days of oil and product in inventory. So we're going to get to a situation potentially where we get demand destruction because these countries can't operate as normal.
Michael, to that point, we have SPRs around the world. Different countries have their own strategic reserves when it comes to crude. Are you basically talking about the fact that we might have the crude, but it's so dislocated in the market right now, there's not going to be enough refining capacity to, say, turn that crude to diesel or jet fuel?
Yeah, I mean, we're talking 17 million barrels a day that has been displaced. I mean, if you look back historically, we've basically had 30 geopolitical conflicts since the early 1970s, and the next biggest disruption to supply was all the way back in 1973 when we had 7% of oil being removed because of the Arab oil embargo. Now we're talking 17% being removed. So it's a massive difference. So, you know, all you need to do is take that 17 million barrels and say how much can be redirected through pipeline, how much can be we offset through demand destruction, how much can come from the relief from Iranian sanctions on floating oil, et cetera, and you add it all up, and you still have a massive deficit of around 8-9 million barrels a day. And that means that can't get to the refiners in Singapore, elsewhere. They can't create the product, and that creates the issue for gasoline, jet, diesel, mainly in Asia.
Michael, the way you talk, I'm thinking this is not going to be months. This sounds like a multi-year recovery. Is that accurate?
I don't think it would be as drastic as that, but as each month goes by, we're talking several more months to recover. The market's very resilient and it'll bounce back, and there is plenty of oil out there in terms of spare capacity, generally speaking. So, if by some miracle this was resolved tomorrow, and all the oil came back into the market, we might lose like 1 or 2 million barrels a day because of the shut-ins, because of infrastructure, etc. But generally speaking, going into this, we were in a surplus of, let's call it, about 3 million barrels a day. So fingers crossed this doesn't go on through past April, because I think if we can get through that, by the end of the year we'll be back to kind of normal.
Michael, this is starting to creep into base metals. Let's just turn from energy to things like aluminum, to copper. We've started to see some big moves there as well. How far along do you think we are in the process of trying to understand how cyclical the demand for those metals actually is at a time when a lot of people are getting bulled up on these secular tailwinds coming out of technology?
Well, I think, let's think about copper here. We said before this conflict that there was some unusual demand situations going on in those metals markets, given the growth of AI, etc., but also because of strategic stockpiling, because of military spending. So I see a very bright future for those metals from that perspective, because coming out of this conflict, I still believe there'll be a push to do more strategic stockpiling for things like copper and aluminium, just like we have for oil. We'll see more military spending. That's very metal intensive. So, despite the fact that they get pulled down because equities get pulled down, I think their future's pretty bright.
Can we finish on gold? Michael, 20% move so far this month. Huge, huge move. What do you think's behind that move? Is it just an interest rate move driving people out of gold? Is there something else at play?
So I think what's going on there is that we don't have any central bank buying right now. I don't think there's any appetite to do that, where countries are squarely focused on getting through this energy crisis. I wouldn't be surprised to hear reports that some central banks have sold gold in order to subsidize some of the energy issues that they have in their countries. So it's been a big pause, I think, in that buying. That's mainly the reason why we've seen it sell off. ETF flows by themselves couldn't explain the dramatic decline in the gold price that we've seen recently. Of course, some of it is fundamentally based on interest rate expectations, etc. But again, a bit like the base metal complex, I think once we get through this oil situation, and with gold prices where they are right now, I would imagine central banks resume their buying.
Michael, good to see you. Thank you, sir. Michael Haigh there of SocGen, working through what's happening in energy, what's happening in base metals and precious metals. Gold down by 5% on the session just today.
This is so interesting when it comes to gold. All these central banks that were hoarding it up. Well, why do you do that? For a rainy day. And potentially they are the ones that are right now out there selling, because they need to move funds around in their government to help when it comes to the energy shock that their consumers are facing.
Right now it's pouring with rain, that's for sure. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran has until 7:40 p.m. Eastern tonight to open fully the Strait of Hormuz, according to a threat by President Donald Trump. The president saying if Iran does not comply, the U.S. will bomb its power plants. Iran countering that it will completely close the strait and target all energy, technology, and desalination infrastructure linked to the U.S. and Israel in the region. The U.S. saying it will not reschedule a summit between President Donald Trump and Xi Jinping until the Iran war ends. Politico reporting the U.S. will propose new dates for the meeting after the active part of the conflict is over. Trump had previously said the summit would happen in 5 or 6 weeks. And Cuba says the country is preparing for a possible military assault. The country's deputy foreign minister making the comments as President Donald Trump increases economic pressure on the government in Havana. Trump saying Cuba could be the next U.S. target after what we saw in Venezuela and Iran. That's your Bloomberg Brief. John?
Yeah, thank you. Thank you very much. Up next on the programme, upending expectations.
Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
Up next, Stephanie Roth of Wolfe Research, live from New York City. You're watching Bloomberg TV. Another morning of big moves in financial markets worldwide. A big conversation about 2 hours away. We'll catch up with Governor Stephen Miran of the Federal Reserve, dissenting, pushing for an interest rate cut at last week's meeting when the market is starting to sniff out an interest rate hike. We'll get into that in a moment. Check out the bond market move. Twos at 4%. For the first time since June, up 11 basis points on the session so far this morning. The upper bound of Fed funds, 3.75. And we've got a 2-year yield trading north of 4%. We'll get into why in just a moment. Turn to the equity market with that move. Equities down by close to 1 percentage point in the S&P 500. The Nasdaq down by 1.1. The Russell down by 1.5. Under surveillance this morning, upending expectations.
We've essentially taken out 325 basis point rate cuts from market expectations over the next 12 months. Markets definitely have priced out the Fed easing that was expected just a few months ago. Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
So here's the latest this morning. Treasury yield surging to 8-month highs. Traders betting the Fed could hike interest rates to combat energy-fueled inflation. Stephanie Roth of Wolfe Research writing, the US rates market is too hawkish. We would put nearly 0% odds of a hike versus the market's 30% odds. Stephanie joins us now for more. Steph, good morning.
Good morning.
Priced out the easing, started pricing in hikes. What's going on?
The market is pricing in a much more hawkish Fed that I just don't think is the reality. And if they end up hiking in the near term, they're going to be cutting pretty significantly following that because they're going to cause a recession.
What do you think's behind this move then?
I think it's a couple things. One, it's a connection back to 2022 because in a similar scenario, we had an oil shock and ultimately the Fed had to hike pretty significantly, but the economy is different. If you look back to then, the unemployment rate was 3.7 falling to 3.5. Payrolls were running at 600,000. Now they're running 0 to 50. And inflation at the time was 5.5%, core inflation, and now it's 3. So the backdrop is incredibly different. There's no way the economy can support this type of energy shock without having some sort of demand destruction.
What is your baseline for inflation for the next 12 months?
We're going to on core inflation, we'll sit a little above 3%. I don't think we're going to get maybe 10 basis points boost to core. And then that will probably come off because we'll end up seeing a demand destruction. When you see airline prices rising 12, 15%, there's going to be some sort of reduction in demand at that point.
Let's go through the sequencing of things, though. First and foremost, the Fed chair comes out and anchors inflation expectations. Sounds like that's goal number one for him in the news conference. And then people start to speculate whether the Fed shifts to a more symmetrical posture. Basically, the communication is there's more chance, as much chance as a hike as there is a cut. Have we got to that part of the sequencing yet? Because I think that's what we're working through at the moment.
Yeah, I mean, I think towards the end of last week, it was more symmetric around hike versus cut. Now it's nearly pricing in a full hike here.
That's where the market is. That's not where the Fed is yet.
No.
Does the Fed start to entertain the prospect of hiking interest rates to anchor inflation expectations in the next few months? And if they do, from a market perspective, is that something you want to step in front of?
I think they might have to do the opposite because we're getting a real tightening of financial conditions here. So at some point in the near term, they might have to come out and say, we're not really entertaining a hike in this backdrop.
So you think the Fed will squarely look through the inflationary shock of higher energy costs and look at, to your point, demand destruction, which basically means lower growth?
I think they're ultimately going to have to. Maybe for now they don't want to get too much ahead of it, but rates have moved so much, I don't imagine they're feeling very comfortable with the amount of the sell-off that we've seen. So they might want to come out and more clearly say, we're not entertaining hikes at any point in the near term.
So if they're not entertaining hikes, that means you think we're going to see a cut fairly soon?
Yeah, I think in the back part of the year, it's fairly likely we'll get a cut. September, perhaps December.
This is the communication dance, though, that I think is really difficult for the Federal Reserve. Let's say Chairman Powell comes out and he's got a conversation, an interview this morning with whoever, with Bloomberg Surveillance. He doesn't, I wish he did, but he doesn't. And he comes on the programme and he says, yes, This is an energy shock. We're going to look through it. What do you think is going to happen to the market then? They're going to price in much higher inflation expectations over the next 12, 18 months out, without a doubt. Which is why, from a communication perspective, I understand why Chairman Powell came out in the news conference. First and foremost, look to anchor inflation expectations and pretend that he's a hawk, even though it's unlikely he's going to hike interest rates. And that's, I think, the communication problem for the market right now. That's what a lot of people have got to wrestle with. That the headlines coming out of the Fed over the next few weeks won't sound like the headlines coming out of the ECB.
Yeah, I mean, you had Waller out on Friday, who's been one of the most dovish voices out there, stating real concern about the inflation backdrop and the closure of the strait. But I think ultimately the Fed is going to have to become a lot more dovish in the medium term.
So how many cuts do you think the Fed's going to have to deliver? Let's say 2027. What kind of things are you thinking about now? Off the back of the energy shock, tightens financial conditions, yields go higher. What kind of cuts do you expect in 12, 18 months out?
I think we're talking 2 to 3 cuts. I don't think it's going to, provided that they don't end up certainly hiking in the near term. I think then we're talking recession-type territory. But provided that this all kind of works out and energy prices eventually stabilize, then we're talking about a couple of cuts. There's a legitimate chance, though, this ends the cycle, provided that the energy prices stay significantly elevated through much of the summer. Then we're talking about a more significant risk of cuts.
So coming into this year, everyone's bullish. There's a few reasons for it. Tax refunds part of it, all this tech spending another. Do you see this move starting to upend some of those bullish tailwinds?
At the margin, but I think we're still looking at an economy that's fairly steady. Provided that the energy shock eventually in the next couple of weeks, there seems to be some sort of off-ramp, but that's very much hinging on oil prices remaining at or below $100 through much of the summer. So I think that's kind of the way that we think about it. If you see oil prices continue to spike, we're talking about $150 through a lot of the summer, that's where the dynamic changes a lot. But provided energy prices stay kind of around the $100 range, then our estimates on 2% GDP can still remain through the rest of the year.
Stephanie, good to see you. It always is. Thank you. Stephanie Roth there of Wolfe Research. I think the Fed watchers are scratching their heads, looking at the move at the front end of the yield curve, because they know the bar to actually hiking is really, really high. Market participants have had a different trade on. They're taking that trade off. So the bond market's been totally whipsawed, and they're facing the prospect of Fed communication changing in the next several weeks, and probably don't want to be on the wrong side of that. Because if the Fed headlines start sounding like the ECB headlines, then you've got a problem if you're on the wrong side of that trade.
Absolutely, and you make the point. Even if Powell was to come out and say, well, you know, we're less concerned, we're going to look through this, what happens to inflation expectations? He almost needs to come out with a little bit more of that tougher talk to keep those expectations in line.
We'll talk to Governor Miran about this. I think if you're not the Fed chair, and if you're not a key member of the Federal Reserve, you have the luxury of saying things that the Fed chair can't. So if you're a governor or a regional Fed president who's thinking, I can look through this shock, we probably need to cut interest rates further down the line, that's a conversation you can have. When you're the Fed chair and your words carry a different weight, first and foremost, as any central bank official, leader, you have to come out and anchor inflation expectations. And that's the sense of what I got from Chairman Powell at the news conference just last week.
And to Stephanie's point, Governor Waller, who we all thought was going to descend, his mind was changed after he realized this strait is essentially closed and not opening up anytime soon.
We'll keep looking at this. Massive move at the front end of the curve, 4% on twos for the first time since last June. Just south of that level right now, a move of 60 basis points on the month so far. Unreal. Up next on the programme, Tracie McMillion of Wells Fargo, Marc, the former Chief of Staff to the former VP Pence, and Wald of the Atlantic Council, and Collin Martin of Charles Schwab. The second hour of Bloomberg Surveillance just around the corner.
This is a really uncomfortable time, I think, for investors.
You look at the paper markets, they've entirely disconnected from the physical markets.
This war is far from being resolved in any sort of positive manner.
We may see a de-escalation at some point that allows energy prices to come down.
We got to take stock and try to be prepared for any potential outcomes.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Another Monday morning that started on Sunday evening. Wild swings once again. Futures down by 0.75% on the S&P. Over 3 weeks of trading, we're down by about 5% on the S&P 500. We're down again this morning on the Nasdaq by 0.9. In the bond market, a 60 basis point move at the front end of the curve in just 16 trading days. Up 10 this morning, north of 4% for the first time since June of last year. Off the back of this, WTI overnight triple digits this morning. WTI and Brent look like this, 98.50 and 112.75.
What we're seeing right now, Jonathan, is the market starting to realize that this might not be quickly wrapped up, even if Iran decides they want to reopen or allow more safe passage of other vessels through the Strait of Hormuz. Why? Because you see a number of energy facilities that are hit. IEA's Fatih Birol said more than 40 energy sites across 9 countries in the Middle East have been severely or very severely damaged. Potentially this means longer disruptions, which means higher oil prices for a lot longer throughout the rest of this year.
Higher for longer in the energy market, higher for longer in the bond market, a tightening of financial conditions, and the conversation shifts. I think in the last week it started to turn. Growth scare. Consensus view of this market, short-term disruption, wouldn't take long. Coming out the other side, you'd see crude prices start to fall off. You saw that in the futures curve. Deep backwardation, i.e. at the front end of the curve, crude's really high, physical market even higher. Further out, the further you look, the lower prices go. That curve's starting to lift at the back end of the curve now, closer to 90 from 60 only a few weeks ago.
Because it will be months until things get back to quote-unquote normal. And amidst all of this, we've really had a roller coaster when it comes to the president's truth account. Friday night, just after 5 p.m., Jonathan, the markets closed. It wasn't a great night for the markets. We're getting very close to meeting our objectives as we consider winding down the operation from the President of the United States Friday, just after 5 p.m. Saturday, 7:44 p.m. If Iran doesn't fully open without threat the Strait of Hormuz within 48 hours from this exact point in time, the U.S. will hit and obliterate their power plants. So now we have an ultimatum in the market, and that ends this evening.
That's 13 hours away. And if you're in this market right now, do you want to be long stocks? Do you want to be short crude, knowing that in 13 hours' time, this could go aggressively one way or the other, depending on what the president has to say?
And I think if you're the president of the United States, you do not send out that truth if you are not willing to do that. And there was a lot of speculation and reports over the weekend from the Wall Street Journal, from Axios, that the president is weighing whether or not to fully take control of Karg Island, basically controlling 90% of Iran's oil facility, be that is just off the shores of Iran. Even if he were to do that, though, does that mean that the strait is open? We've been talking about, with a lot of analysts on this program, the asymmetric risk of a ship going to that strait, whether it's drones or whether it's mines.
That's the headline risk going to this evening. Equity futures down by 0.8% on the S&P. Coming up this hour, we'll catch up with Tracie McMillion of Wells Fargo with stocks on a 4-week losing streak. Marc, the former chief of staff to the former Vice President Mike Pence, discussing President Trump's ultimatum, and Collin of Schwab revising his outlook for Fed rate cuts. We begin this hour with stocks adding to losses as the war in Iran is showing no signs of slowing down. Tracie McMillion of Wells Fargo writing, if the S&P 500 approaches the 6,400 to 6,500 range, risk-reward starts to improve based on expectations that the conflict is measured in weeks, not months. Tracie joins us now for more. Tracie, welcome to the programme. We've talked about it a million times on this programme. Energy shock, bond market rupture, growth scare. Where are we with the growth scare?
Good morning, John. Yes, so we're at a position now where we think that growth continues in the United States. However, we do see higher energy prices, inflationary pressures starting to diminish that potential growth somewhat through the end of the year. However, we do see this conflict still measured in weeks, most likely. And what that means to us is that there's probably going to be an inflationary bulge that moves through the data around mid-year and then starts to look more comfortable to markets and to the Fed by the end of the year. So we're telling investors to look through a lot of the headlines here and take advantage of opportunities that the market is giving us.
Where do you think value is being created? Where are opportunities opening up at the moment?
Yeah, so we tell our investors that it's important to have a diversified allocation. So that includes equities, it includes fixed income, real assets, and alternatives where that makes sense, because that gives us the opportunity to sell high and buy low. And right now, those opportunities to sell are in commodities, in energy, in the energy sector, and moving some of those assets from commodities into equities, and within the sectors, from the energy sector moving into financials, industrials, and utilities.
Just getting a statement from the president, Tracie. Annmarie's going to go through that statement. The headlines across him right now. I can tell you the price action reversing up by more than 1% on the S&P 500. In the bond market, yields were aggressively higher. Yields have pulled off those highs. The 2-year virtually unchanged on the back of this, and crude turning much lower. 94 on WTI, Brent at 108. Annmarie, what's the president got to say?
So the president is saying that he's postponing strikes against Iran power plants, that talks with Iran are continuing, and he told the Department of War, what he says, this is the DOD, the Pentagon, to postpone those strikes. He's talking about the fact that they've had talks with Iran regarding how to end these hostilities, and these talks have happened over the past 2 days. He says this postponement, putting a bit of a timeline on it, a different timeline now for the president. He's talking about the postponement will last 5 days and has instructed the entire Department of Defense to postpone all strikes against Iran. Jonathan, this is a major de-escalation coming from the White House.
So let's go through this statement. It's on social media, posted just moments ago, and you could see almost immediately the markets start to turn around. I'll read it in full for you. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. The president in that statement just moments ago. So let's work through the asset classes. A complete turnaround from where we were 5 minutes ago. Start with equity futures. We'll go stocks, bonds, and then commodities. Equity futures on the S&P 500 higher by more than 2 percentage points. A massive move in the equity market. In the bond market, yields were higher at the front end of the curve by more than 10 basis points. Now they're lower by 3 to 387. And in commodities, a huge turnaround there too. We were up. We were trading at triple digits overnight on WTI. Now we're trading at 91. We're down by 7% on the session on WTI. On Brent, we're down by 8.
Remember, Jonathan, coming into this morning, what we had from the president was an ultimatum by 7:44 p.m. this evening that if Iran did not open the Strait of Hormuz, he was going to strike Iranian power plants. And then a ton of rhetoric coming from Iranian officials, especially across X and a number of social media platforms. Now the president is saying, and he's pleased to report, he says, that they've had good and productive conversations. My question is, who exactly is he having these conversations with? But he's saying, based on the tenor and tone of them, they want to take it down, take the rhetoric down, and take the strikes down. He's talking about basically a 5-day period of a détente between Washington and Tehran. A lot of questions about what the Gulf Arab partners have to say about this. A lot of questions if Bibi Netanyahu is on board with this. But at this moment, the president is clearly trying to de-escalate the conflict.
So my response would be, OK, these are the words of the president. Where's Iran on this matter? Who are they speaking with in the Iranian government right now? Is Iran on board? That's the next headline you're waiting for off the back of some of this. Tracie, I'm assuming you're following this conversation right now. Big turnaround in financial markets. Tracie, this is almost impossible to trade. Coming into this morning with this massive ultimatum hanging over this market. And I said before these comments dropped, it's so difficult to be long a market when you know you could get whipsawed in one direction or the other. Tracie, is this sufficient enough for you to take risks this morning?
Yes, we are taking risk. We're actively rebalancing portfolios back into those areas of the market that have sold off. And this is just another illustration of how fluid the situation is and how quickly those opportunities come and go for investors. So it's really important, we think, at this time to have a shopping list ready. And when those opportunities arise, start to invest.
Tracie McMillion of Wells Fargo. Tracie, thank you. Breaking down some of these market moves. Let's go through it again. A few moments ago, the President of the United States posting on social media the following: I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East, based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Off the back of this, a big turnaround in financial markets, starting with stocks. Equities higher by 2.8% on the S&P 500 after being lower by almost 1 full percentage point going into that headline. In the bond market, yields through 4% for the first time since last June, now back to 381 and down by 9 basis points at the front end of the curve. You're seeing wild moves throughout this market. We'll turn to crude, of course, driving absolutely everything worldwide at the moment. Brent and WTI. Brent and WTI look like this. WTI was trading close to triple digits. It's now trading at 86.88 and down by close to 11.6%. Brent back below triple digits at 99.95 briefly, down by more than 10%, around $100 a barrel on Brent after being close to what, 114?
Yes.
Going into these headlines.
This is absolutely an insane move in terms of the markets across the commodity sphere as well as also across rates and what's going on in equities as well. The president clearly wants to de-escalate this situation. But, Jonathan, I have a ton of questions regarding this Truth Social post from the president. I want to know who he has been in discussion with in terms of the Iranian regime, given the fact that their top brass has been absolutely decimated. And also, if the president is saying he has instructed the Pentagon for 5 days to not strike Iranian power plants and energy infrastructure, does this also mean Israel is on board? Because we saw Israeli attacks very early this morning in Iran. A lot of questions remain. And the president is also talking about the fact, Jonathan, that these talks need to continue in a good way, an optimistic way for the next 5 days in order for there to be this, I would call, a mini détente. Well, who is talking to who? What sort of timeline? How are they talking to each other? Is there going to be a meeting? Lots of questions.
That's the next headline we're waiting for. What's the Iranian response to the president's declaration just moments ago? This is what we'll do on the programme. We'll go through the market moves for you. We'll get you an update from Washington, D.C. and we'll head over to the Middle East and hopefully touch base with Jumana Basachi in a few moments' time as well to find out what the Iranian response might be to a statement like that from the President of the United States. In the meantime, let's get you an update on this and more for your news worldwide with your Bloomberg Brief. Yahara joins us now for more. Hey, Yahara.
Hi, John. As we were discussing a de-escalation in the war with Iran, President Donald Trump posting on Truth Social, the United States and Iran have had very good and productive conversations regarding a complete and total resolution of our hostilities. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure over a 5-day period. But ahead of that, EIA Director Fatih Birol saying more than 40 energy assets across 9 countries in the Middle East have been severely or very severely damaged by the war. Birol adding the damage to oil fields, refineries, and pipelines means it will take some time for them to come back online. And another top story here, New York's LaGuardia Airport is closed until at least 2 p.m. Eastern today following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 41 people were hospitalized. The NTSB is launching an investigation into the incident. That is your Bloomberg Brief, John.
Yahara, thank you. Up next on the programme, escalate to de-escalate.
We have demolished the Iranian capabilities, and every day we are taking out their missiles, their missile systems, and the factories that build those missiles. Sometimes you have to escalate to de-escalate.
We're getting that de-escalation this morning. Equities session highs on the S&P 500 higher by 2.7%. Up next, Marc, the former chief of staff to the former VP Pence from New York City this morning. Good morning. A statement from the President of the United States shaking up financial markets worldwide. Check it out this morning. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East based on the tenor and tone of these in-depth, detailed and constructive conversations which will continue throughout the week. I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Coming into this morning, there was an ultimatum hanging over this market. The president looking for an off-ramp.
The president looking for an off-ramp. He chose this off-ramp of de-escalation. He's saying that there have been talks, the first I'm hearing of it, the last 2 days between Washington and Tehran, which is peculiar, of course, because every time you've spoken to the president, you see reporters ask him this question. He says he's unsure who's actually running the country. You have made the point, Jonathan, and this is critical. We need to understand from the Iranians, that is the next statement this market's waiting for, about what exactly was discussed. Is this really a 5-day détente potential that the DOD will not go after Iranian power plants and energy? Or potentially is this the president just trying to put some optimism back in financial markets?
It's almost impossible to trade this market. Look at these moves. Equity futures up by more than 2% on the S&P. On the Russell, up by more than 4%. The airlines are absolutely flying. Forgive the pun, in the pre-market, in the bond market, 2s, 10s, 30s. 2-year yields were through 4%. 20 minutes ago, 381.79. We're down 8 basis points now in the session, and the bigger moves in crude. WTI and Brent, WTI overnight, triple digits. Right now, 88.80 and down by about 10% on WTI. Brent crude down by 9.9. And I have to keep going back to all of this. The statement from the president is one thing. The details matter. Who's he speaking with? Who in the Iranian government right now, they're having these in-depth talks they're so encouraged by? And 2, where's the response from the Iranians this morning? They're the headlines I'm looking for, and I imagine most market participants are looking for as well.
I'm scouring Twitter to try to see what the head of the Iranian parliament, the president, Peshkian, or the foreign minister has to say, because these individuals have been the ones that have been responding to the president's truth over the course of the weekend. Just think about how Friday started, Jonathan. Friday evening, markets didn't do well. The president coming out saying, maybe we're going to wind down, and then it was back to escalation in terms of this evening. We're supposed to have this ultimatum.
And let's get to the coverage from the Middle East. Joining us now, leading our coverage, Jumana Basechi. Jumana, whipsawed by headlines. The reaction, please, to this one.
Well, I mean, quite the development and perhaps the tackle moment that markets were looking for. But as you and Annmarie were saying, we haven't had a response from anyone in Iran yet. So let's just wait and see whether these conversations that he has alluded to have actually been taking place. And also, as we've been flagged in prior reporting, what the Iranians have been asking for in terms of the outcome that they're looking for from negotiations. In past, they've referenced the fact that they want to get security guarantees, or guarantees rather, that the U.S. will not strike Iran again. And they have maintained that they would like to see an outcome in which they can still effectively control the Strait of Hormuz. Of course, that is an outcome that is unacceptable to the U.S. and also to Gulf states. But that being said, I think one thing that is clear here is, and we spoke about this last week, the attack on civilian infrastructure, and specifically the Israeli airstrikes on that gas field in Iran, was deemed to be one step too far, a red line for the U.S. And remember, President Trump tried to distance himself from that. The fact that he went one step further this weekend and implied that the U.S. may hit energy infrastructure and power plants in Iran was also deemed to be a red line for Gulf states because of the potential reprisal and the impact that that could have on the region, not just on their energy infrastructure, but also on desalination plants as well. They're buying time here. He's pushing it back by 5 days. But whether this is going to lead to a big diplomatic breakthrough, still a big question. We have to hear from the Iranians.
Yeah, Jumana, stay close. When we get that reaction, no doubt you'll have it for us first. Jumana Basechi there out of Dubai. Marc Shaw, the former chief of staff to the former vice president, Mike Pence, joins us now for more. Marc, welcome to the programme. 20 minutes ago, we were having a different conversation about ultimatums, and now it's something else. How would you characterise that statement from the president?
Well, look, Jonathan, the president likes to hold all the cards, and he certainly likes to negotiate publicly, as you saw through the weekend. But, I kind of feel in some ways, it's not a perfect analogy, but somewhat similar to the aftermath of Liberation Day. I think we know the president watches markets closely, but not just equity markets, also bond markets. And you've seen treasuries continuing to go higher. And as we head to the midterms, the number one issue for American voters remains affordability. And so certainly if energy prices stay escalated, that has an impact. But if you also are seeing treasuries continue to rise, then I think that has an even greater impact on mortgages and a lot of other things. And so I think that the president is clearly de-escalating here. I mean, to y'all's point about it'll be interesting to see how Iran responds, but if we've essentially basically debilitated much of their offensive capability, I'm not so sure that that is as critical. I mean, I think there's a question about the authenticity about the negotiations, but at the same time, I'm not sure it makes as much difference how they respond if the president is taking his foot off the gas.
Mark, that's what I was going to ask you about, the authenticity and how this is so different from Liberation Day, because the president was almost negotiating in the open with himself when it comes to Liberation Day. He was able to control that lever in terms of how high tariffs would go. With this, you have Israel involved, which as of this morning, will continue to target Iranian facilities, and the Iranian regime. Is this potentially just an empty statement?
I don't know, Annmarie. I think it's hard for Israel to get out in front of the United States on this. I think there's no doubt that Netanyahu has looked at this opportunity ever since October 7th to defend Israel and to take offensive measures. But at the same time, from an international perspective and feedback internationally, I think he really can't get too far out in front of the president of the United States on this. And so I think that the president does hold a lot of the cards here. And we'll see if there actually does generate some sort of movement in the Straits of Hormuz, or if that, I think, is the crux of the issue to watch over the next 5 days.
Mark, what's driving him? Financial markets or the midterms?
I think that he's probably less concerned about the midterms. I think, Annmarie, that normally I think you'd look at this and say, hey, look, do you really want to go through impeachment again? But I don't think that really concerns him as much. I think he views it as I've overcome that. I don't think he's ever really worried about others on the ballot as much as himself. And so I think this is more about market reaction. I think he's concerned about the economy. He's concerned about affordability. And look, I think that in some ways, I think the president's success in lowering energy prices in the first year of his administration, in some ways, I think masked much of the cost of his trade agenda. And I think that now that energy prices have spiked, I think some of that will come out is a more detrimental to the president. So I think that's what's really his focus here, is addressing the affordability issue.
Marc, it's good to see you. Thanks for jumping on and reacting to that breaking news. Marc Short there, the former chief of staff to the former VP, Mike Pence. The president looking for some form of de-escalation. Signal matters. A concern maybe about what's happening in financial markets. But I think we have to draw a comparison and contrast between Liberation Day. It's not Liberation Day. There was no retaliation. There was no war on Liberation Day. It was the president. He could dial the lever up. He could pull the lever back. It was in control almost entirely of the outcome in financial markets. This is different. Iran has already come out and said over the past week or so that they want to make it so painful this never happens ever again. And Iran's response in that way is absolutely critical this morning, and that's the headline we're waiting for now.
And also now Iran for sure knows what the President of the United States pressure points are. Higher yields, Jonathan, and much higher energy prices, especially during an election year.
Well, this morning, following those headlines, we've got lower yields. We're down by 4 basis points on a 2-year, around 3.85. Equity futures much higher, up by 2% on the S&P 500. Up next, Alan Wald of the Atlantic Council on the prospect for talks in the Middle East. This is the kind of financial market we're all in at the moment, that you can have a market completely turned around and whipsawed by one social media post from the President of the United States. And here is that post from 30 minutes ago. There was a big ultimatum hanging over this market. If Iran didn't reopen the Strait of Hormuz, the US would bomb Iran power plants, decimate them. We've seen these headlines all over the weekend. And we had just 12 hours left before that headline, that ultimatum expired. And then this drops. We're going to postpone the strikes against Iran. Postpone them for 5 days because the talks have been so constructive and so good with our Iranian counterparts.
News to me that there were even talks happening the past 2 days. So a lot of questions immediately. Who exactly is the president talking to, or who are his envoys like Steve Witkoff or his son-in-law Jared Kushner actually talking to? Which is why you were right to point out immediately, Jonathan, we need to understand and wait for a statement from the Iranian side to understand almost the authenticity of these talks. If true, though, the president is saying that there will be 5 days, or maybe he's just buying more time for himself and the DOD. He's saying there will be 5 days of postponement of military strikes against Iranian power plants and energy infrastructure. It also is interesting that he only mentioned those two. Energy infrastructure and power plants are other targets potentially still on the list.
I got this message from a Bloomberg subscriber just moments ago in real time. Everyone's following this. 1, it's news that there are talks. one. And two, it's news there are even people to talk to. That seems to be the takeaway from some market participants this morning.
I've gotten a tremendous amount of message. People saying he's tacoing, others saying we can no longer say taco. Stop using that term. This is diplomacy in action. And another person asking me, who is the president talking to if we decimated the top brass of the Iranian regime? And we have not physically seen, we've only seen statements from the new supreme leader. There are individuals potentially. Steve Witkoff's counterpart really was the Iranian foreign minister. He has been very prolific on Twitter, as has the Speaker of Parliament and has the president. These are politicians. Potentially, these are people, if the president is saying there actually were talks, and we know authentically we find out there were, these are the individuals I imagine the U.S. is negotiating with.
So let's work through the price section off the back of the statement from the President of the United States. Futures higher. They were down by 1%, now higher by more than 2%. On the Russell, small caps outperforming, up by 4%. Airlines flying in the pre-market, banks are too. The energy names that had rallied over the previous few weeks giving up some of those gains. In the bond market, 2s, 10s, 30s shaping up as follows. Yields were higher, particularly at the front end of the yield curve. Briefly this morning, through 4% for the first time since June, now back down to 3.85. And in the commodity market, the main event, of course, WTI was trading in triple digits overnight. It's now at 90, and we're down by 8%. Struggling to keep up with all of this. Let's get you some morning movers, some single names. Danny has more. Hey, Danny.
Hey, John. The whipsaw on these names has been remarkable. All of the travel stocks rallying pretty significantly. To be fair, they're not making up for the losses that we've seen. Carnival, for example, is down more than 17% since the war broke out. United is down more than 12% since the war broke out. But all of these names rallying at least 5% off the back of that Truth social media post from the president. The flip side of this, you mentioned this as well, John, it's the energy stocks that are also up double digits since the war broke out, but they move lower alongside the price of oil. Cheniere Energy down almost 4%, Oxy down 2.8%, Devon Energy down 2.3%. Now, not all the moves are logical, but they are happening fast and furious. I want to show you what memory chip stocks are doing, because they have also erased their losses and are now rallying. These stocks have been selling off at the Kospi. The Kospi today closed down more than 6% as some positioning unwind happened because of the fears over the war in Iran. Again, these aren't necessarily directly exposed to the war, but memory chip stocks were down hard. They too turn around, up as much as 2.8% in the case of SanDisk. John?
Danny, take a breath, get some rest. We'll see you in about 60 minutes' time. Who knows where we'll be an hour from now. On our radar this morning, President Trump posting a major update to the war in Iran, instructing the Pentagon to postpone any and all strikes on Iranian energy sites following 2 days of productive conversations with figures in the country. Who in the country? We still don't know. Elsewhere, crude rolling over after President Trump's post. Brent and WTI falling by double digits before pairing some of those losses. And finally, the IEA reporting more than 40 energy assets across the Middle East have sustained severe damage, with refineries and pipelines being choked off. Officials are expecting long-term hits to global supply chains.
This is where the problem is. Even though you see the energy markets, financially, the paper markets absolutely whipsawing, in the physical market, it is no longer just about the Iranians controlling the Strait of Hormuz and essentially it is closed for most vessels. It's the fact that now actual energy facilities have been disrupted to a point where it is going to take months. And for some of these facilities, like in Qatar, it is going to take years to get them back up to where they were. And that is why you have the IEA coming out with a little bit more of a concerning tone about where the energy space is going, because it's not just what's happening present day. It's 5, 6, 7 months, even 12 months out in terms of potentially the hit to supply chains when it comes to certain commodities.
Can we just sit on this social media post from
Please.
the president? It's always difficult to get into someone's mind. I don't know what the motivations are. I don't know who they've been speaking to. We're going to have to wait for the Iranian readout of whatever's happened here. But I can tell you that based on the communication I'm having with Bloomberg Terminal subscribers this morning, a number of them who have written to me already, there are severe doubts and a lack of trust with the administration right now as to whether these talks have happened, are happening, or even will happen over the next 5 days.
That's exactly what I'm getting as well. A number of people saying he is tacoing, but is that even real? Also, he has said there's no one to talk to, so who are these talks with? I will tell you, Jonathan, we do not have a statement yet. Iranian officials haven't yet commented. They haven't confirmed that there's been discussions, but there is a headline right now running on Iranian state TV that says, quote, U.S. President retreats after Iran's decisive threats. They're saying they're retreating after Iran's threats. That signals to me potentially there are going to be questions about the authenticity of these talks.
This is the latest from the president posting on Truth Social. The US and Iran have had positive talks, also instructing the military to hold off fresh attacks on key infrastructure. Wald of the Atlantic Council joins us now for more. Ellen, you've read the Post. We've all read the Post. You've seen the market moves. What's your reaction to them?
It's incredible how much the market will move based on a post by the president, which has no backing. We've seen no proof. We have limited information from the other side, but it's incredible how much the market is moving, and the market hasn't even opened yet. So I think that we're really seeing in real time just how much this war is impacting not just stock markets, bond markets, and energy markets as well. And I think Annmarie's point about how we're in a phase now of this conflict where we're seeing long-term damage happen to energy infrastructure across the region. And that's going to be long-term. And I don't think that we're seeing that long-term damage reflected very much in, in the price of Brent. It's really moving based on, a couple words and a tweet, and that's not really reflecting the state of energy.
And signal and substance. The substance, people have questions about the substance. What does it signal? How instructive is the signal?
So the signal is, I think, really important because it signals that there is movement towards de-escalation, and that's generally good. Of course, I think if we look at what's happened in the past, we know that 5 days is a really long time. And it's unlikely that there will be zero military movement in those 5 days. And in fact, Trump was clear. He says, we're going to hold off 5 days on attacking, power plants and the like. He didn't say that they're not going to do anything else. And so I think that this is a little bit of breathing room, but I would not be surprised if in 2 days we see, or even less than 2 days, we see the resumption of military attacks, maybe not exactly on power plants, but definitely attacks. And I would be surprised if we see any serious movement of ships in the Strait of Hormuz.
Ellen, basically, is the president, though, telling the Iranian regime what exactly his pressure points are for the future? How does the U.S. win the war then?
Well, I think that he's actually communicated that he's willing to deal with higher energy prices for some time. I think that the fact that it's gone on this far and that we've seen Brent, hitting in the, up in the past 100 and in the above 110, I do think that he's showing them that he's willing to sustain this for some time, and that a lot of what he'll do to kind of pacify the American public is kind of jawbone the market a little bit. So yes, he does have pressure points, but I think that's really more in terms of like sending ground troops than it is higher energy markets.
For the words to become reality, what do you want to see? What needs to change in the region?
I think we need to see serious efforts by the Iranians to show that ships can have safe passage in the Strait of Hormuz. We need to see a cessation of these drone strikes, because that's really what I think is causing a lot of the tension there and a lot of the problems. I don't think we're going to see the cessation of all kind of military movements, but certainly fewer drone strikes, definitely no drone strikes at energy infrastructure. That would definitely show markets and also companies that things are moving in a somewhat serious way towards resolution.
Ellen, you wrote a book, Saudi Inc. If you were the CEO of Saudi Arabia or the UAE, one of the leaders of these countries, what would you be doing right now with these types of headlines? Do you think this is purely de-escalation? Or are you preparing potentially to enter this conflict in a more meaningful way?
I'd be prepared both, to get things back to normal, but I'd also at the same time be very, very wary and understand that this could just be a prelude to more escalation. And I would be preparing for that. I'd be on the phone with all of my GCC neighbors, and I'd be on the phone, if I could, with the White House to understand not exactly what they want to happen or what is going to happen, but at least the range of possibilities so that I could prepare my people, my country, and the very important energy companies that exist there for a range of possible scenarios.
Ellen, just before you go, it's hard to call this a market when we're at the mercy of a social media account at the moment. What's your advice to people at the moment? How are you going to go through, navigate the next several days into a new headline?
It's going to be very, very choppy. I think that there's a lot of volatility, and if you're not interested in, kind of the heart attack that comes with volatility, then maybe tap out for a little while.
Adam Wald, the Atlantic Council. The volatility in energy has been absolutely wild, and the volatility of the last hour equally as wild. The headlines from the president: there was an ultimatum set over the weekend, ultimately a deadline for later on this evening, that if the Strait of Hormuz did not reopen, the power plants in Iran would be struck by the US, and I imagine Israel as well. That ultimatum has been taken away. The new deadline is what, 5 days, because the talks have been so good?
Because there were talks allegedly over the weekend, news to me. We continuously ask this question: who exactly in the U.S. administration is speaking, and to who in Tehran, more importantly, are they talking to? I'm getting a lot of messages, Jonathan, from individuals saying this is probably Trump maybe just buying time. And one individual notes correctly that there are amphibious assault ships that are still making their way to the region. And if the president wanted to do something in a little bit more of an escalatory manner with those individuals, he has to wait for them to get there.
This is a war, and we're waiting for the other side to respond, to see their readout of what's happening right now. The president says there are talks. We were unaware that those talks were going on. The president has changed the deadline, ultimately from this evening to 5 days' time. These are all things we're waiting to see what the other side says. Ultimately, there's a path there to de-escalation if the Iranians want to take it. Whether there are talks or not, their response is going to matter.
And I think it's also important to understand, is the president trying to buy time, or was he moved by pressure points in financial markets? Yields going up like Liberation Day, higher energy prices, and not seeing an off-ramp, and that is why he is willing right now this morning to de-escalate. It's going to be incredibly important to understand what Iran says, and also for those that are watching, who is actually taking more of a leadership role in this regime right now. Who responds to the president of the United States?
Futures just off session highs, positive by 1.9% on the S&P, with an update on news worldwide. With your Bloomberg brief, Yahara has more. Hi, Yahara.
Hi, John. A de-escalation in the war with Iran. President Donald Trump posting on Truth Social moments ago, the United States and Iran have had very good and productive conversations regarding a complete and total resolution of our hostilities. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure over a 5-day period. Meanwhile, 2 Indian-flagged vessels making their way through the Strait of Hormuz. The ships are following a route taken by others approved by Iran. They are likely heading to India, which is facing shortages of liquefied petroleum gas and has been in talks with Tehran to secure cargoes of the fuel. And the U.S. saying it will not reschedule a summit between President Trump and President Xi Jinping until the Iran war ends. Politico reporting the U.S. will propose new dates for the meeting after the active part of the conflict is over. Trump had previously said the summit would happen in 5 or 6 weeks. That's your Bloomberg brief. John.
Yahara, thank you. What a start to another trading week. Absolutely whipsawed by 2 headlines. A deadline, an ultimatum that was set for later on this evening, changed to 5 days' time because talks have been constructed between the US and Iran, according to the President of the United States. A massive turnaround in financial markets. Up next, we'll break it down with Collin of Schwab from New York City this morning. Good morning. You're watching Bloomberg TV. I can tell you the Iranian response just dropping across the Bloomberg. Annmarie's going to go through that in just a moment. This is what it looks like at the moment coming into this. The president had an ultimatum, a deadline of this evening, that if they didn't reopen the Strait of Hormuz, they would strike power plants in the country. About 50 minutes ago, the president said this: I am pleased to report that the United States of America and the country of Iran have had, over the last few days, very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Annmarie, what talks?
The Iranians are saying this is fake news. This is coming from Fars, their semi-official news agency, saying there's no direct or indirect contact with President Trump. And they are saying that this has not happened. There are no talks. Also, Jonathan, the regime is really galvanizing the president's truth, saying that this means Trump has retreated to the threats that Iran put forward after the president gave that ultimatum.
Some stunning headlines crossing the Bloomberg terminal. The equity market starts to turn around just a bit. We were higher by about 2% on the S&P 500, now up by 1.6. In the bond market, yields are up by 10 basis points at the front end, then aggressively lower, now trading at about 390 on twos. And in crude's still down on the session by 6 to 7% at the moment. WTI at 91, Brent crude at 104. This is really, really difficult to be a part of this financial market right now in any asset class when you're going to get whipsawed by a headline from the president, a social media post that's then denied by the Iranian media 50 minutes later.
And now that it's denied, I think potentially there's no longer this 5-day potential détente the president was almost calling for. We're not going to go for power or energy infrastructure for 5 days, given that we had constructive talks, which means the president is likely going to respond again. He's going to be asked about it again. It's not even 8 a.m. this morning, and he's going to be asked and say, the Iranians say there were no talks. Can you please give us some more details?
Collin Martin and Charles Schwab joins us around the table, wondering what on earth to say about any of this. Collin, good morning.
Good morning.
I'm going to give you the luxury of time and space to respond to this however you like. How difficult it is to be in financial markets right now when the President of the United States says there are talks and Iran, according to the semi-official news organization that just published these headlines, Iran is saying there's no direct, indirect contact with the president.
Yeah. Well, thank you for kind of giving me the open-ended question. You know, the way we're framing it is, I'll respond by saying it is really difficult right now. And that's how we're framing it with our clients. It's really hard to kind of be a hero in investing right now because there's two-sided risks because we don't know. The fundamentals are kind of out the window right now, and it's more at the whims of what we're going to see on social media and decisions by President Trump. So we made a decision a few weeks ago, collectively at Schwab, to kind of dial down the risk a little bit and kind of make a point. Now's not the best time to be adding riskier investments or being too aggressive.
There was a moment I remember several years ago before the pandemic, the trade escalation, the tension with China. And there was a moment when the president came out, and I've talked about this story a few times over the last month. The president said there was a phone call with Xi. There was a phone call with China. And China never confirmed the phone call. And a lot of people in financial markets don't believe the phone call ever happened. But what mattered was the signal. Ultimately, the president was looking for de-escalation. And the signal at that time mattered. Is it different this time? Does the signal matter less or matter just as much?
I think it does matter. I think I don't want to throw that, well, I'm going to say the taco trade, whether it's right or wrong. But I do think that President Trump, the administration, is seeing what's happening. Obviously, the riskier parts of the market, if you look at stocks, relatively well-behaved given everything that's going on. But I think the bond yields are probably spooking them a little bit. We saw that with the tariff announcement. And, you know, 440 on the 10-year this morning, not great for mortgage rates, obviously. And it's going against really what one of his main plans was, bringing long-term rates down and affordability for Americans. So I think it is probably spooking him a little bit. And I think we do need to take from this signal and maybe hope that there is some sort of de-escalation going forward.
So he's basically priming financial markets that anytime yields go up, I am going to try to de-escalate. But what does that send in terms of, it's different than Liberation Day. This is a time of war. What is the signal he is sending to the regime?
Yeah, no, it's a challenge right now because, as you said, we don't know what the response is going to be right now. And also, if there is a de-escalation right now, a lot of damage has been done. So it's not like we're going to see a big reversal in oil prices back to where we were just a few weeks ago, less than a month ago. Inflation expectations are up. We're expecting it to continue to rise. So it kind of puts a floor somewhat on Treasury yields if we continue to see inflation where it is. So, yeah, there's not an easy off-ramp here. We think it can help at the margin, maybe signal that we can bring the temperature down a little bit. But it's not like this is a flip of a switch where everything is going to be great again.
Has this volatility created some value in the bond market? And at what point along the curve is getting interesting? Around 4 on 2s, around 440 on 10s?
Yeah, we're a little bit nervous about taking too much interest rate risk right now. Even coming into the year, we thought yields could rise to this 4.5% area. Not for these reasons, though. It's not like we expected this. But inflation was still too high, budget concerns. This is probably going to add to the budget concerns because wars tend to be inflationary. We need to finance them. But I think there's just so much uncertainty that there's a risk that long-term yields continue to rise. So we're not there just yet. And given the shift we've seen in Fed expectations, the risk of reinvestment risk has come down a little bit. So maybe staying short and earning close to 4% without much duration, maybe that's a little bit more attractive.
It's super boring, but I've heard this so many times from Fed watchers who just believe it's impossible the Fed hikes this year, that the bar should be super, super high. They're not going to hike. And now that you've got yields trading above where Fed funds are, there's some value here. And this is a 2-year yield, by the way. And if you think the Fed's going to hike in the next 12 months, there's even bigger arguments they'll cut by even more in the following 12. Is that the point that's interesting to you? It sounds boring, I know, but 2's at 4% is kind of wild compared to what was expected for Fed funds at the start of the year.
Yeah, no, I think the case can be made that looks pretty attractive because I still don't see the case for hikes right now. I think the bar is pretty high. I'm worried about what the negative consequences are if this conflict continues to go on. So far, the markets have really been focusing on inflation, but there are negative consequences, knowing that the economy was, I think, pretty strong going into this, but there were cracks forming. Obviously, the labor market stabilizing, but not necessarily strong. And obviously, a rise in gas prices and energy prices, that's going to hit the lower income parts of the market. What does that do for growth going forward? And how does the Fed balance that?
Collin, it's good to see you. Thank you, sir. Collin Martin there of Schwab, trying to figure this out. What we're hearing from Iran and the reporting out of Iran right now is that there have been no talks and there are no talks.
And another one from an Iranian state media, Tasnim, saying there have been no talks, are no talks, citing a senior security official. They say they will continue to respond and defend the country. So right now, not the off-ramp maybe the president was looking for.
Equity futures on the S&P positive by 1.3%, just off session highs. We'll keep breaking this down. Mike Contopoulos of Bernstein joins us in just a moment. Andrew Hollenhorst of Citi and Fed Governor Stephen Miran in the next hour. Look out for that conversation in just a bit.
The moves that we're seeing in the front end of the curve, absolutely nothing shy of spectacular.
The central banks aren't taking any chances.
It is now leaning towards hikes more than cuts.
We still think the next move is a cut.
What's going to happen? And the answer is, we don't know.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and it already feels like Friday. A week-long market session already this morning. Equity futures look like this, positive by about 1% on the S&P. Somewhere in between the high and the low of the session so far. The Russell up by 2%. Wild moves in this market. In the bond market, 2s, 10s and 30s. 2s were 3-4% only a few hours ago. Then down to the 380s, right now 392, and yields are higher again by 2 basis points. In the oil market, energy shaping up as follows. WTI overnight, triple digits, right now 92.90, and down by 5% on the session. Wild swings there too. Off the back of this, a statement for the president about an hour ago that read as follows. I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions. Okay. That's the president's position. The first reaction we had to that post, what do the Iranians have to say about this? Are those talks even happening? State media responding just moments ago.
State media says those talks are not happening and there's been no contact with the United States. An additional report now coming from Tasnim news agency, also semi-official news agency, saying not just that there are no talks, and they're citing a senior security official, but they're saying the president's comment is psychological warfare, going on to say the Strait of Hormuz, something we know that this administration and Western allies and Asian allies want to see reopen, says the Strait of Hormuz will not return to pre-war state through PSYOPs. So right now, what the Iranians are saying is not only there are no talks, they are saying that the president actually retreated. For domestic consumption, this is important. They're saying the United States is backing down and retreated after hearing the regime was saying that they're going to target all power plants in West Asia.
This market is almost untradeable right now. A lot of positioning would have got cleared out in the last hour or so. People caught offside on the wrong side of the trade. Then they have to reset again this morning. We've seen this a number of times over the last week. I'm deeply uncomfortable in moments like this. Difficult to trust Iran on any given day. Hard when you can't trust the President of the United States. And that's the tone I'm getting from financial market participants. Not my opinion. Bloomberg Terminal subscribers writing in with their doubts about the content and substance of that post by the President even before we had that response from Iran.
Absolutely. Everyone on here was basically saying, how authentic is it? Who are they actually talking to? That is a great question. I do think it's interesting when you look at the Iranian response. It's coming from semi-official state media. Not a single person is putting their name on it. So I think that is interesting because it really has been unclear who really has the power, the center of power right now in that country. Also, Jonathan, where do we go from here? The president has an event in Memphis, Tennessee this afternoon at 1 p.m. Eastern. Will he talk to reporters on the way to that event? Will he talk about Iran at that event? Potentially, that is going to be the next key point for this market this morning.
It's not the first time that the president has said communications are happening with another country and they haven't been verified by the other country. We saw that with China. I mentioned that before the commercial break. We saw that with China in the trade talks before the pandemic, I believe in the summer of 2019. But what mattered to markets then is not really whether it happened or not. What mattered was the signal that the president wanted to de-escalate and move away from the tension with China. The market traded on that. That was what was important to financial market participants. For market participants this morning, it takes two. It's not just about the US. Iran needs to come along for the dance and de-escalate as well. And you're not getting that signal from the other side.
Or potentially the president is just trying to buy time, to be ambiguous, because actually there is an amphibious assault ship, another one, that is headed to the region. And maybe he's just waiting for all his ducks to be in a row before he decides whether or not he is going to do what the reporting over the whole weekend was, potentially taking over Karg Island.
Big 60 minutes coming up to try and figure out all these things. Coming up shortly, we'll catch up with Mike Contopoulos of Bernstein, with stocks jumping on comments from the president, Andrew Hollenhorst of Citi breaking down the economic impact of the war, and Fed Governor Stephen Miran, the lone Fed official pushing for an interest rate cut, joins us later this hour. We begin this hour with our top story. The president posting that the US is delaying any and all strikes on Iranian energy sites following productive talks. Iran with something different to say. Bloomberg's Jumana Basechi joins us from Dubai for more. Jumana, a very different tone coming from the Iranian side.
Yes, that's true. But let's just for a moment unpack half of that statement, which is the fact that President Trump has pushed back the decision or the potential to strike power plants in the region or in Iran over the next 5 days. That is welcome, of course, for many of the participants in the region. And I think many people here in the Gulf, where I am, are breathing a sigh of relief that there isn't going to be that type of action happening in the next 24 hours. Now, the second part of the statement, which is where he talks about discussions taking place with Iranian officials, there hasn't been anything from the Iranian side to signal that that indeed is the case. And if anything, we've had a denial from Iranian affiliated media saying that no direct or indirect discussions have been taking place. We haven't heard from individuals themselves, so key figures like the foreign minister, Abbas Araghchi, or the speaker of the parliament, who have tended to be very active on social media over the last couple of days with these various threats of retaliation. So yes, an attempt to de-escalate, and certainly the market is interpreting that way. But I think, again, here you have to distinguish between what is signal and what is noise. And what we know is, number one, we have to hear from the Israeli side as well. They are also engaged in these military operations in Iran, and so far there's not been an official statement from them, so you would think they would be privy also to what the US are doing. Number two, the strait is still effectively closed, which means that effectively you have 10 million barrels a day of oil that's being taken away from the market, still effectively being policed by Iran. Number three, energy infrastructure is still damaged. And earlier today, we heard from the IEA, they estimate that 40 sites in the region have been damaged or severely damaged. It might take months, even years for that to get back online again. And then finally, as we found out from on Friday, the US are still planning on sending thousands of Marines to the region, and they should arrive in the next couple of weeks. So I think you have to distinguish between the short-term signaling versus long-term, more medium-term, what is happening on the ground. And we haven't heard from some key players yet.
Jemana, well framed, as always. Good to catch up. Jemana Basechi there out of Dubai, leading our coverage of this war as it enters week 4. Mike Contopoulos of Bernstein joins us now for more. Mike, good morning.
Good morning.
Jemana did a great job of talking about the removal of near-term escalation risk. That's one thing. The hope of pricing in the end of this war, though, is quite another. And when the president says we've had these great conversations about a complete and total resolution of our hostilities in the Middle East, that's been essentially denied by the Iranian side. So that's the setup for this morning. Help me with this. How on earth do you trade this market in an environment like the one we're in right now?
Well, I think it's very difficult, Jonathan. You know, you've got to be an investor, I think. You've got to look past just the daily news and the headlines and think more about what's to come over the next 6, 12, 18 months. And that's clearly really hard to do. But there's certainly a direction being set that I think investors, need to sort of navigate. That direction is higher inflation, probably higher rates. Those two things are certainties. There were certainties in our view before the Iran war. There's certainly certainties after the Iranian war. So for me, you've got to be an investor, not a trader. In a time like this, you've got to navigate the noise and you've got to fall back on what you know, not what you think.
So inflation's higher, rates are higher than people thought. Is growth lower? Is the growth profile weaker from here on out?
I think that's still to be determined. The one advantage the entire world had was going into this, you had pretty strong economic growth. In the U.S., for Q4, you're probably running pretty close to 17% year-on-year earnings growth. And I think in the first 2 months of this year, things were actually looking pretty good as well. So you came into the Iranian war, I think, pretty healthy. Clearly in the U.S., jobless claims remain very, very low. Even internationally, both within Europe and emerging markets, I think the economic situation, the earnings situation for stocks, which is what you care about, was actually quite healthy. Now, obviously, if oil were to stay, well into the 115, 120 or above range for a long period of time, that can change. But I think we'll see that through a lot of the economic signals, whether it's industrial production, whether it's PMIs, whether it's jobless claims, et cetera. You're going to start to see that filter through if that weakness is going to persist.
When do you think we will see potentially when you start to think, actually, this is a growth hit? Because already United is talking about how they're going to have to spend so much more money on jet fuel.
Yeah, I mean, I think one of the things that we have to think about is how much of that strong growth was really due to low oil prices, in the 60s for a very long period of time. I think there's certainly part of that. That's true. You're seeing the K-shaped economy. Of course, we've all talked about that so many times. You've seen that lead to stress in pockets of the credit market. So there is certainly stress out there. I think you probably are going to get a lot of information over the next coming, month or so. I'm not sure that you want to be too reactionary to the data. We saw what happened during tariffs where you got a few bad prints and all of a sudden things took off again. But certainly the longer this goes, the harder it will become. I mean, it is a tax on consumption, higher oil prices, that is.
Steve Miran is coming up at the end of the hour. What do you think this means for the Federal Reserve as the market is starting to price in hikes?
Yeah, I wish Steve and I were on at the same time. I'm sure it'd be a lively discussion.
Well, you could wait around for him.
Listen, I don't think there's any, certainly, reason for cutting at this juncture. I mean, never in the history of markets have you had a Fed cut in these sort of situations where you have, above target inflation, the dollar's doing what it's doing, the volatility in the markets, et cetera, et cetera. I think there's a very good chance the Fed hikes later this year.
Wow.
The only problem is this. Obviously, this is a supply disruption. And so that does change the calculus a little bit.
But if this becomes a growth disruption, how does the Fed hike into that? Wouldn't that do a tremendous amount of damage?
Well, so far, again, coming in, like I said, with quite a strong economy, I think gives them a lot of leeway on the growth component. So if you have unemployment go up, 0.5%, 0.75%, but inflation's at 4 or 5, I think inflation becomes the bigger part of the mandate. You have to, basically dent demand in order to bring down inflation in that case. And, you end up with a little bit of a catch-22 for the Fed. But you saw in the 1970s what happens when you let inflation get under control, and that's much worse for the economy and for employment later.
Can I rephrase what you just said, and you tell me if it's an accurate description? Kevin Walsh hikes interest rates later this year.
I think that's entirely possible.
That's what you think might happen?
I think it's entirely possible.
Wow. Can you imagine the tension between the White House and the Fed if that happens?
The Fed's independent, right, Jonathan? So I believe in that independence. I think they do as well. I know, I'm sure, you guys are chuckling over here.
I'm just thinking the next headline, as Jonathan says, that headline is a Truth Social from the president saying Kevin Warsh should be fired.
You know, anyone in the media is long drama and volatility. Okay? If anyone's smiling, that's why.
Well, listen, I mean, even the markets today are pricing in roughly a 50% chance of a hike or going into today in October. So it's not an outlandish statement, really, even when you consider the markets.
So it's interesting because a lot of people see that move and they want to step into it. I've heard it just repeatedly over the last week. The bar to hike is so high, yields above Fed funds here around 4%. There's value there. Let's get into the front end of the curve. Are you pushing back then?
Well, listen, I think 4% cash yields are probably okay. What we did at RBA is we actually bought floating rate about 2 months ago. And we continue to like really, really high quality floating rate debt. So not leveraged loans where I think there is some stress, but really high quality AAA type floating rate securities. I think that's sort of the safer place to be. But certainly, listen, if you're in T-bills or something of that nature, I think that's a fine place.
Where's that leave the outlook for stocks, if that's the outlook for bonds?
So, again, it depends on how much growth really takes a hit here and how badly margins are compressed. You know, I certainly think that U.S. stocks, believe it or not, which I know have held up well relative to the rest of the year, remain vulnerable, particularly because of the growth component, the long duration nature of the U.S. stock market with, you know, the big mega cap tech names, a lot of the speculation being here in the U.S. We saw in 2022 when you had higher rates, what happened? Those sectors actually took the biggest hit. And so I think as long as you're out of excess in the markets, out of speculation, I think you're going to do okay over the longer run.
I've always wondered what a real cyclical test would look like for these tech names. There's a whole ecosystem built on what people believe are secular tailwinds. CapEx, tech CapEx, that's not going anywhere. How cyclical do you think some of that is?
Incredibly cyclical. I mean, I think time and time again we've seen tech is a cyclical sector. The most recent example of that is the last 4 years or so. In 2022, when you had an earnings recession, tech took the biggest hit. And as you had earnings reaccelerate, tech did quite well. And that's the definition of cyclicality. And so I think if you were to hit a recessionary scenario, if you're going to hit a growth slowdown, particularly if it's accompanied with higher interest rates, and tech's incredibly vulnerable. Incredibly vulnerable.
Mike, it's good to see you breaking it down. Thank you, sir. Mike Contopoulos there of Bernstein on the bond market, suggesting that maybe the Fed can hike by the end of the year. And on the equity market, those tech names, it's not just a secular growth story. There is a cyclical component to some of that as well that you need to think about. The headlines keep crossing, so this is where we are. The president had an ultimatum on Iran that if they didn't reopen the Strait of Hormuz, he would bomb their power plants by this evening, essentially. That was the deadline. Got a new deadline. It's 5 days because apparently talks are going so well. What we're hearing from the Iranian side through media operations, state-backed media organizations, is that those talks aren't ongoing. They're not even happening.
And there's multiple now. We just got a third from another semi-official news agency saying no talks between the U.S. and Iran. And another headline from this particular news organization saying requests to reduce tension should be put to the U.S. It is an interesting moment for this regime that is an existential threat that is trying to survive. They could have taken this phantom phone call, potentially phantom, because the president's saying it's happened and they're saying it didn't. But they could have taken this off-ramp the president was offering them and say, yeah, there are talks. We want to come to the table. We want to meet you in Muscat this weekend. And they're not. They're doubling down. They're saying the United States is retreating.
Two different things to think about for market participants, signal and substance, and the difference between pricing out escalation risk, near-term escalation risk, and pricing in long-term peace. Generale Berset, who leads our coverage out of Dubai, I think did a wonderful job of really giving us that framework for thinking about things. We've removed near-term escalation risk. And the near-term escalation risk was that if the Strait of Hormuz didn't reopen, the president, the US, was going to bomb energy infrastructure, power plant assets that are key for civilians across Iran, and Iran would no doubt respond in kind. That's the escalation risk that's been removed, at least for the short term. Now we're talking 5 days, not 12 hours. Pricing in long-term peace is a completely different effort. And when the other side says they're not even having talks with you right now, it's difficult to price that in this morning.
And I am struggling to understand the signal from the president. Is he just looking for an off-ramp? You have another Iranian news agency saying that Trump's comments are an attempt to cut energy prices. So now the regime is potentially saying, we know what your pressure points are. Higher bond yields and much higher energy prices, especially in a midterm election year. And we're going to make it as painful as possible for you. Or is the president trying to buy time? Because he does has an amphibious assault ship heading to the region. Is that what this is all about? We don't know.
We remove that near-term escalatory risk. Equities are still just about positive, even as Iran denies those talks are even happening. The signal matters here, up by 1.5% on the S&P. With an update on news worldwide with your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump posting a potential major de-escalation with Iran, as you all were just discussing, instructing the Pentagon to postpone any and all military strikes against energy sites in Iran for 5 days after what he calls productive talks. However, Iranian state media denying the talks occurred, saying there is no direct or indirect communication with President Trump. Meanwhile, Israel saying it's still pressing ahead with the strikes on Iran despite the updates on the situation. Israeli officials have not yet released a statement responding to the potential breakthrough. IDF officials saying the country is currently conducting strikes against regime targets in the heart of Tehran. And here in New York, LaGuardia Airport is closed until at least 2 p.m. Eastern following a deadly accident. An Air Canada Express plane with 76 people on board collided with a fire truck shortly after landing last night. The pilot and co-pilot died in the crash, and 41 people were hospitalized. The NTSB is launching an investigation into the accident. That's your Bloomberg brief. John?
Yeah, thank you. More updates on that throughout this morning. An important story here in New York and, of course, beyond. Coming up on the programme, Andrew Hollenhorst of Citi with the global economy whipsawed by rapid developments in the Middle East and one social media post in particular. That conversation up next from New York City this morning. Good morning.
The president is clearly de-escalating here. We know the president watches markets closely, but not just equity markets, also bond markets. I think this is more about market reaction. I think he's concerned about the economy. He's concerned about affordability. That's what's really his focus here, is addressing the affordability issue.
That was Marc, the former chief of staff to the former Vice President Mike Pence, joining us following a bombshell announcement for the President of the United States indicating there are talks between the US and Iran. Ultimately, those talks are going well, and for that reason, the ultimatum, the deadline for later this evening, if they don't reopen the Strait of Hormuz, the US will bomb power plants. That's taken away. That deadline goes away, and now it's a 5-day period for talks. Talks that Iran is denying are even happening right now. Equity futures on the S&P positive by 1.7% in the bond market. Yields all over the place this morning. Two's very close to 4 earlier on, now back down to 387.
It's a very confusing morning, Jonathan, when you have whipsawing in the financial markets because you have different takes in terms of what is going on when the president and Tehran are saying talks are happening versus not happening.
Andrew Hollenhorst of Citi joins us around the table. Andrew, it's not Friday, it's not Thursday, it's still Monday morning, believe it or not. We've had about a week's worth of price action in 12 hours so far. What's your outlook for the economy and what's changed off the back of the moves in energy and the moves in bonds?
Yeah, I mean, I think this move this morning just shows us how much markets are not trading economic fundamentals right now and just responding to every headline. And I think that's just, we have to acknowledge that's where we are with markets. In terms of the economic fundamentals, I think your prior guest said this, and I agree. This is a supply shock. This is a classic supply shock. It's going to mean higher prices, but it's also going to mean damp demand. So that's going to be a difficult spot for the Fed.
Sequencing matters for the Federal Reserve. Communication first and foremost to anchor inflation expectations. What are you reading into that? Do you think the market might be reading too much into that at the moment?
I think what we heard from Powell last week, and Powell was perceived as hawkish, I think really the message he was trying to send, and he said this, was we don't know what's going to happen with the geopolitics. We don't know what's going to happen with the oil price. And even if we knew all of that, we would still have questions about what that means for the U.S. economy. So I think this is a Fed that's trying not to give too much guidance. But we have seen an interesting response from global central banks. I think there's an impression from global central banks, from the Fed as well, that maybe the reaction to this supply side shock is going to be more hawkish than what we would typically think. Usually the textbook supply side shock, you look through it, you kind of hope and pray that it's relatively temporary and you don't have to raise rates in response. Because of the context, because we came from an experience where inflation has been overshooting, the Federal Reserve and global central banks under-responded to that overshoot of inflation, I think now there is a nervousness among central bankers about sending that message very clearly that yes, they do take inflation seriously. And that means, and I think unfortunately, that means We're getting interest rates that are now moving higher and are tightening. Whether central banks raise policy rates or not, the market is tightening policy. The market is tightening financial conditions. That's going to slow the U.S. economy.
So they're scarred from the transitory error.
That's right.
But isn't this so much different in terms of the economic setup than 2022?
I think it's completely different. And I think the biggest difference in the U.S. is the demand backdrop and the labor market backdrop. I mean, looking back in those days, we had high inflation, but we also were generating some months 500,000 new jobs per month. If you look at the U.S. economy now, we can argue about where the break-even is for job creation, but we're running essentially zero job growth. And that's not just looking at that 92,000 jobs that we lost in the last jobs report. You take a moving average, 3-month moving average, 6-month moving average. It's a zero job growth economy.
GDP wasn't horrendous in 22. It was a market shock.
Yep.
Keep going back to that. It wasn't an economic shock. The recipe we have in front of us now has the real potential to be an economic shock, to be a big hit to growth. Difficult to hike into an environment like that one compared to 22.
Yeah, very, very hard to hike, I think. And that's why I think what you're going to see, and again, I think that's what the Fed was trying to guide to, maybe the market didn't take it that way, is just on hold right now. And, you know, we're getting these headlines. We don't know where the price of oil is going to end up. Where are we going to be at the April FOMC meeting? Where are we going to be at the June FOMC meeting? It could be a very, very different world than what we're
Never mind April FOMC. Where are we going to be by the end of this week? I've got no idea. Andrew, good to see you. Andrew Hollenhorst there of Citi. Lots of reaction to the headlines we've seen in the last hour. This from Peter Cheer of Academy. 5 days gives more time for the Marines to get in place and for the US to attack sites the Iranians can use to attack ships in the Strait. It also gets us to the weekend.
Yep, potentially the president is just buying time. He needs that amphibious assault ship in place.
Up next, Neil Dutta of Renmac with the global economy whipsawed by rapid developments in the Middle East. Live from New York City this morning, you're watching Bloomberg TV. A market whipsawed by headlines over the last 90 minutes or so. This from the President of the United States just 90 minutes ago, posting, "I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. Based on the tenor and tone of these in-depth, detailed and constructive conversations, which will continue throughout the week, I've instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, subject to the success of the ongoing meetings and discussions." The President, about 90 minutes ago. First question we had, what talks? News to us. What does Iran have to say about this? And Iran, through state media, is pushing back.
Yep, they threw cold water absolutely all over this. A number of semi-official news agencies. Now remember, at some point, we have in the past, these news agencies are definitely propaganda for the regime, but they're all lining up to say that there have been no talks when it comes to Tehran and Washington. One of them now, Jonathan, just saying that the statement of the U.S. president are part of efforts to reduce energy prices and buy time for the implementation of his military plan. So potentially saying that we know what the president's pressure point is, and that's financial markets, and that's energy prices in a midterm election year. And the Iranians still think that maybe they will be more attacks. The president just needs his ducks in a row.
I keep returning to what Jemana said earlier on this morning. Jemana Bassett, she added to buy about 30 minutes ago. The difference between removing near-term escalation risk and pricing in long-term peace. What's just happened in the last 90 minutes or so? Regardless of what Iran's got to say about this, what does the president actually have control over? Why does the signal matter here? He's removed near-term escalation risk. There was a fear coming in this morning that in 12 hours' time, the US would be bombing power plants in Iran, and Iran would be doing the same back and hitting energy targets, infrastructure all around the Middle East. That's the escalation this market was worried about. The near-term escalation risk has been removed. Now we're talking 5 days out. The war continues. So to price in long-term peace, really, really difficult. So you're not seeing massive moves in crude relative to the run-up you've seen over the last month. You're seeing some relief maybe in the equity market. I'd also say you're probably seeing a flush out of positioning given how one-sided this market had become a little bit earlier this morning.
It's absolutely impossible to price in what happens in terms of this conflict in the long term. To your point and Jumana's point about the near-term escalation risk, what I did find interesting is that the White House has retweeted the president's truth, but they highlighted only one part. I have instructed the Department of War to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, and they lead the tweet with, Trump calls for a pause on all military strikes against Iranian power. Trump calls for a pause. That is how the White House is interpreting the president's truth.
So our Bloomberg terminals are lighting up. Lots of subscribers writing in. A lack of trust right now in some of the communication coming from either side. Who to trust, what to trust. This from Marc Collin of JP Morgan, formerly of JP Morgan, now independent, writing this out on social media. This is a net negative for markets. Manipulation will cause liquidity to disappear and real problems will stay. Now, manipulation is quite an allegation. He can have his own opinion on all of that, but the perception of manipulation is very, very important. And if that's a widely held view right now, that is a problem for liquidity in financial markets. Who wants to put trades on in an environment like that?
Not saying there has been manipulation, but the financial community has been talking about for weeks now 3 things that have gone on during the course of this conflict, this being the third. The first, that tweet that was posted by the energy secretary saying they had a successful U.S. Navy vessel come through alongside another vessel through the Strait of Hormuz. And the other, of course, is there's been a tremendous amount of speculation within the financial community and the market about a very large individual selling oil futures. The Treasury Department, individuals were speculating, stepped into the paper market. Now, that didn't happen, according to what sources are telling me, and also just saying that this was under discussion. But that's why you get statements like this.
Wrestling with all of those headlines this morning. Futures still higher by 1.5% on the S&P. With an update on some single names, some morning movers, Danny Berger has more. Hey, Danny.
Hey, John. Good luck to anyone long or short this market this morning. I want to show you what some of the exposed industries are doing. We've seen fertilizer stocks rally hard as fertilizer gets hard to produce as products like urea don't make it out of the Strait of Hormuz. Again, these are stocks that have rallied double digits since the war in Iran broke out. You are seeing the fall, at least in CF industry sticks. That's down 5.3%. This NTR, this one is only down by about 1%. So not all stocks are reversing all of their moves. But again, for the most part, it is sticking. The airlines and energy stocks are an example of this too. If we look at what some of the travel ones have done, these were up as much as 5%. Now we're up about 4.5%. So again, still big moves, not as extreme as before we had that denial from Iran Carnival. The worst faring of all of these, down 17% since the war broke up. That's up 4.6% this morning. United up 4.5%, and Delta up 4.1%. Finally, I mentioned the energy stocks. Again, a reversal taking place after the gains. Occidental, those shares down 3.7% this morning, closely tracking the price of oil. So yes, John, they're not as extreme as you first saw, but for the most part, the moves, at least directional wise, are sticking.
Danny, appreciate the update. Looking forward to the show as well. Danny Berger alongside Matt Miller in about 30 minutes' time, guiding you into the open and bow. Joining us now to discuss, Neil Dutta of Renmac. Neil, welcome to the program, buddy. Let's take a beat together. Wow, what a 90 minutes in financial markets. Neil, what on earth do you tell clients when they pick up the phone and ask you what's going on?
I say, let's talk about the data from February.
And they respond, Neil, no, thank you. Why is that relevant in an environment like this one?
My clients aren't calling me for war strategy, John. I think just, point everyone to what Rory Johnston said. We had him on our own podcast a couple of weeks ago. And, basically this is about the cumulative deficit of energy flowing in the world. And that hasn't changed. I mean, the Strait of Hormuz is closed, the cumulative deficit builds. And that ultimately pressures energy markets, particularly in those countries that, rely on the, free flow of energy through the Strait. And that's really the Asian economies. And I think that's worth noting because a lot of those economies have been, and those markets have been responsible for the broader boom in global equity markets over the last year, particularly, when I think about Korea, Taiwan, what's going on with tech and semiconductor stocks. Those are sort of the epicenter of that. And, at some point, people are going to start to begin thinking about not just oil prices, but what the oil is used for. And so that's sort of where my head is at. I have no useful opinions on the he said, she said, what this means.
Do you think, though, Neil, that this Truth Social post was about what is going on in financial markets, higher bond yields, and concern about energy prices spiking, and the president wanted to get out in front?
I mean, it's possible. Maybe he wants to buy himself time. I don't know. I mean, that's within his remit. But, ultimately, it's difficult to win a war if you're constantly looking over your shoulder at financial markets and public opinion.
Friday night, just after 5 p.m., the president said they're getting very close to meeting objectives and they're going to wind down. Then, of course, Saturday, 7:44 p.m., he came out with that threat, an ultimatum about 48 hours. Then this morning, he said there's a 5-day détente. So what do you do with all of this? Wouldn't you have been better off leaving on whatever you thought the rest of the week was going to look like Friday night and ignored everything else the president said?
Well, look, I mean, I don't think you should be executing trading strategies based on what the president's saying on a day-to-day basis. I think you have to sort of go back to first principles. Is the Strait of Hormuz open? No. Is there energy flowing throughout the world? No. Is the economy sluggish going into all this? Yes. And everything that we're seeing, frankly, still reinforces the notion that the Fed is on hold. So to the extent that, people had been anticipating rate cuts later this year, we're not at a point where the markets are going to be really betting on rate cuts again. So that reinforces the downside to the economy that we've seen. And so if you're a U.S. macro economist like I am, I mean, you kind of have to think about what that means for the domestic economy. And, when I look at that, I see that's not good for housing. Obviously, mortgage rates have been climbing. And it's not good for consumer spending because, even if oil's coming in a little bit today, that's not really going to translate into what people pay at the pump. And so I think that represents a significant hit to disposable income. And it continues to kind of keep people talking about from a lot of the enthusiastic things they were talking about earlier in the year, like tax refunds. I mean, we've effectively neutralized all that. So an economy that had been very sluggish going in remains sluggish still.
Now, how symmetrical do you think the Fed's reaction function is?
Well, I mean, I think the hawkishness will work provided that the unemployment... I mean, I do think that the Gulf War one analog is very, very useful. I mean, it's kind of... if you go back to that period about a year before, the Fed had been easing. Then I think in the summer of 1990 saw a big spike. Oil prices doubled. And guess what? The Fed stopped cutting. And they only resumed the cuts once oil prices began to decline in earnest. In the interim period, the unemployment rate was generally going up. So I do think the Fed will probably talk hawkishly. You can't ignore what's happening in energy markets and what that might mean for inflation and inflation expectations. But I think they'll ultimately stop short of actually hiking.
Neil, Governor Miran, up next on the programme. Any questions you want answered, happy to present them to him in a few moments' time.
I don't think you need my help.
Neil Dutta of Renmat. Neil, thank you. Thank you very much. Governor Miran joining us in about 5 minutes' time. We'll get his views on this economy and whether this energy shock changes things at all.
I think for him, he's just going to say you want to look through the energy shock and potentially he's going to talk about what has happened in the past. Interesting, Neil doesn't have any questions because last time Governor Miran was on, you were actually off. Neil was in the studio and they both stayed on because Neil was like,
I was picking questions out.
Yeah, Neil was like, I actually have some questions for the governor, so maybe he'll write in.
I have no doubt he will. Futures higher by 1.6% on the S&P with an update on news worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump posting a potential major de-escalation with Iran, instructing the Pentagon to postpone any and all military strikes against energy sites in Iran for 5 days after what he calls productive talks. However, Iranian state media denying the talks even occurred, saying there is no direct or indirect communication with President Trump. Meanwhile, we are seeing crude prices rolling over after President Trump's statement on de-escalation. Brent and WTI falling by double digits before paring some of those losses. The International Energy Agency describing the current crisis as the largest oil supply disruption in history prior to this morning's developments. And Newark Liberty International Airport temporarily halting all departures after evacuating all staff from its control tower. That decision following a deadly accident at another New York City hub, LaGuardia Airport, late Sunday that killed 2 pilots on board on an Air Canada flight. Officials at Newark lifting the ground stop for departing flights in just the last few minutes. That's your Bloomberg Brief. John.
Yahara, thank you. It's so difficult to keep up with this. You've got official sources, state-backed media. This is coming from Axios, that Turkey, Egypt and Pakistan have been passing messages between the US and Iran over the past 2 days in an effort to de-escalate, according to a US source.
Yeah, I imagine you're going to have some countries that want to say they can come in and mediate. We also heard that from the Omani foreign minister this morning on Twitter. Also, Jonathan, the president, fresh to Fox News, deal with Iran could be 5 days or sooner. He's saying this to Fox News, even though the Iranians say there is no talks.
Equity futures on the S&P pushing higher once again, up by about 1.9%. Up next, we'll talk about Fed policy with Governor Stephen Miran from New York City. You're watching Bloomberg TV. So this is where we are this morning. The president says there are talks with Iran. Iran says there are no talks. They say that through state-backed media. This came from Axios just moments ago, that Turkey, Egypt and Pakistan have been passing messages between the US and Iran over the past 2 days in an effort to de-escalate, according to a US source. Of course, escalation risk was sky high coming into this morning, with a deadline for later on this evening, an ultimatum, if you will, that if Iran didn't reopen the Strait of Hormuz, the president would ban energy assets, or rather bomb power plants in Iran. Iran, of course, would then respond in kind across the Middle East and strike Gulf nations. This could have got really messy. Have we addressed some of that risk so far this morning?
I think we've addressed some of it in terms of the United States going after power plants, and the president is de-escalating from that threat he had, that 48 hours in terms of 7:44 p.m. this evening, that was supposed to come to fruition. Of course, the question is, what happens, Jonathan, come Friday?
So in the market right now, equities near session highs, up 2% on the S&P. This bond market, some wild moves earlier on this morning. Yields through 4% at the front end of the curve. Highest yield we've seen since last summer, 385 now, because we've pulled back following those headlines. We're down 5 basis points on the session. We've priced out the easing. At one point, we were talking about pricing in rate hikes at the Federal Reserve. Let's have that conversation right now with the Federal Reserve Governor Stephen Miran, the lone voice dissenting at last week's FOMC meeting, continuing his push for interest rate cuts. Governor Miran joins us now for more. Steve, good to see you.
Good morning. Thanks for having me back.
Governor, where do we begin with these headlines right here? As a policymaker, as an official, when things are moving this fast, what do you do?
Well, look, we've already had some whiplash this morning, and I think that underlines that we shouldn't be making policy based on short-term headlines, right? We should wait for all the information to come in before really changing our outlook. And I think it's just still premature to have a clear view about what this is going to look like as you look 12 months out. And because of monetary policy lags, we really need to be looking a year to a year and a half out. And there's just, not enough information yet about what that looks like.
Communication in the near term, of course, matters. The chairman in the news conference last week really vowing to anchor inflation expectations. Do you think that's a worthwhile pursuit at this point?
I do. Look, traditional central banking, Federal Reserve wisdom is that oil shocks hit headline inflation, but they don't really pass that much into core by as much as they do into headline. And the two ways that you would want to respond to it, and so therefore you typically look through an oil shock. Now, the two exceptions would be if inflation expectations beyond the first year start to move higher. That hasn't happened thus far. Inflation expectations for the first year out have moved higher, of course, but as I look at the CPI swap market, beyond the first year, there hasn't been that much movement. Medium term, longer term, five-year forward expectations have actually been coming down lately, right? So there's no evidence of that. And the other reason why you would want to respond to an oil shock is if you saw a wage price spiral, if you saw wages responding to oil price increases, gas price increases, that could result in the type of reinforcing inflation dynamics that you want to forestall. Now, again, thus far, there's little evidence of that. In fact, wage pressures have been declining for the last few years on a steady basis. So that's also something that I don't really see right now.
So the labour market's just not strong enough to worry about it?
I think the labour market still could use additional support from monetary policy, and that's why I dissented last meeting, as I have continued to dissent for all previous meetings.
How lonely were you at that committee meeting just last week, voting for a 25 basis point reduction in the face of an energy shock? How robust was the conversation around the table?
Look, I think a lot of people around the table, like me, were hesitant to draw conclusions from the oil news thus far because, as I said before, we have to look 12 to 18 months out, not what happened to the oil price yesterday, right? And so looking 12 to 18 months out, there's still not enough clarity to think that monetary policy itself should adjust in response to what's happened.
Well, check out the oil futures curve. That has changed. I've just had one eye on December over the last 3 weeks or so. Yeah. That's gone from the 60s and threatening to break out into the 90s at one point earlier on this morning. That's a change. That's a real step up, no?
It has, and I boosted my, in the summary of economic projections, I boosted my inflation dot for the end of the year to 2.7%, reflecting that in part, right? So there is some expectation of higher headline inflation. However, as I said before, I think it's way too early to draw conclusions that it's bleeding beyond headline inflation in a way that matters for monetary policy. Don't forget, higher oil prices also depress demand, right? They take money out of the pockets of consumers that we spending on other goods and services and redirects it towards gas and other energy costs, and that depresses demand and causes unemployment to move a little bit higher. That offsets some of the increase in inflation.
One of your colleagues this morning, Austin Goolsbee at the Chicago Fed, speaking to the press, saying we could see a circumstance where we'd need to raise interest rates. How high is the bar to raise interest rates? What kind of circumstances would you personally need to see?
Yeah, so I just laid out a couple of them before, right? If it looks like the oil shock is bleeding into inflation expectations beyond the first year, then you get really concerned about second-round effects. Or it looks like you're starting to cause a wage price spiral. Then you get really concerned about second-round effects. First-round effects are not something you traditionally respond to as a central bank. Now, I'll say one thing beyond that, which is that these oil shocks have been things that the Fed has looked through for a long time, right? It would be highly unusual for the Fed to start looking through them now. And when you think about what happened in 2021 and 2022, we did have negative supply shocks, like the oil shock from the Russia-Ukraine invasion. But in my view, part of the reason why it was able to reverberate through the economy the way it did was because policy settings at the time were very different. Monetary policy and fiscal policy were at all-time historical accommodative levels. We were doing $120 billion a month of QE. We were doing $2 trillion fiscal packages at a time. That's not the case right now. We're not hitting the gas on demand that would interact with the higher oil price in a way that would reverberate these prices through the economy now. That's not the case at all.
But right now, we're just seeing price spike on paper market, but what's happening in the physical market is actually a void. We are seeing not just shut-ins, but some of these installations going to take years to rebuild. At what point does that start to potentially de-anchor inflation expectations?
Yes, so you'd want to see the oil price shock start to reverberate through supply chains and pushing up prices more broadly.
We are, though, in terms of airlines, diesel, that means that it's going to be more expensive in terms of some goods and services that are delivered by truck.
Yeah, there's been a few instances, but you want to see that in a broad-based way that starts to bleed into core inflation and boost it in a way that's sort of not just a one-off time, but you start to see really second-round effects that are concerning for the longer term. And if that starts to happen, then you start to get concerned about inflation. And I think that is what you did see happen in 21, 22, and thus far I don't see it happening on a broad basis. Now, it could happen, right? But thus far, it hasn't happened on a broad basis. You get some idiosyncratic stories like airline prices that are more directly tied to jet fuel, but beyond that, you haven't really seen it. And I think part of the reason why is because we're not hitting on the gas. We're not hitting the gas on demand. We're not boosting demand with all-time record accommodative policy in a way that would allow pricing to accommodate a supply shock like that.
It's fair to say that I think a lot of Fed watchers watching this right now, and I'm getting some reaction from them in real time, agree with you that this isn't the environment to hike rates. The opposite, though, is a difficult argument to make. Is it the right time to cut interest rates this quickly, this soon?
Yeah, so, as I said before, traditionally you would look through an oil price shock like this, which means that my policy outlook from before is unchanged. And my policy outlook from before would be gradual cuts of interest rates. I had about 6 cuts for the year at the last step in December. I reduced that to 4 cuts for the year in response to the inflation data. right, that we received between the two projection periods. So I'm maintaining my outlook that I had.
It's not just that the outlook doesn't change, Governor. Forgive me for jumping in,
yeah.
but the balance of risks around the outlook should change. That should change off the back of an energy shock. Isn't that a fair summary of where we should be?
Well, the balance of risk does change, but I think it's actually changed on both sides equally. The inflation risks have got a little more concerning, but the unemployment risks have gotten more concerning too, because the negative supply shock that is the oil price is also a negative demand shock. You're taking money out of goods and services that are not energy that would have been spent on those goods and services anyway. And I viewed the labor market as continuing its gradual softening trend of the last 3 years. That trend has been in place for 3 years. I've seen nothing that would convince me the trend has stopped, right? That's a very, very powerful medium-term trend that's been in place for several years now. And taking money out of goods and services that's not energy to devote to higher energy prices is exactly the type of thing that worries me that trend might accelerate. So the balance of risk changed, but I think it got worse on both sides. I don't think it changed asymmetrically.
Governor, it's good to see you. Thanks for making time for us, as always. We appreciate it, sir. Governor Stephen Miran there of the Federal Reserve on the argument for lower interest rates following a major energy shock.
Major energy shock, and the headlines continue, Jonathan. The president is basically saying that negotiations took place last night. Iran says they didn't. To be continued.
Coming up tomorrow, Cameron Dawson of New Edge Wealth, Kate Herr of JP Morgan Asset Management, Emily Rowland of Manulife, and the Cisco President and Chief Product Officer, Jitu Patel from New York City. What a week already. This was Bloomberg Surveillance.